Royal Commission is now in session.
Mr. Bolster.
Thank you, Commissioner. Before we commence with the panel of 4 bank witnesses, I understand there is at least one appearance.
Yes, thank you, Commissioners. Doyle Marquardt for Westpac.
Yes, thank you, Ms. Marquardt.
Commissioners, I call 4 representatives of each of the 4 major Australian banks. The first one is Thea Horden. The second witness is Chris Williams. The third witness is Sam Morris, and the 4th witness is John McCarthy.
Ms. Horden, do you swear by Almighty God that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. Williams, do you swear by Almighty God that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. Morris, do you solemnly and sincerely declare and affirm that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. McCarthy, do you swear by Almighty God that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Ms. Horden, could you please state for the record your full name?
Thea Horden.
And you are the Head of Health and Aged Care for Westpac Banking Corporation, correct?
For Westpac Institutional Bank.
And the bank has prepared a statement, which, if that could be pulled up, please, it's WPC *999 0001 0001. You should be able to see that on your screen very shortly. You're familiar with that document, although it's been prepared by the bank itself?
I am.
And are you able to speak as to the truth of its contents?
I am.
And is it true?
It is.
Good, thank you. Mr. Williams, could you please state your full name for the benefit of the Commission?
Christopher Williams.
And you are the Executive General Manager, Major Client Group, Business Banking, Commonwealth Bank of Australia, correct?
That's correct.
And if we could please bring up the document ID CBA *999 0002 0001. That's a document with which you are familiar. It's dated
yes, I am.
June 2020. And are you able to speak as to the truth of the contents of that document?
Yes, I can.
And it is true and correct, I take it?
It is. It is.
Mr. Morris, could you state your full name for the benefit of the Commission, please?
Samuel Morris.
You may have to do that again. That came through quite crackly.
Samuel Morris.
And you are Head of Health, Corporate and Institutional for the Australian and New Zealand Banking Group, correct?
I am. And
if we could bring up the bank's statement, which is RCD *999 0393 0001. You're familiar with that statement dated the 30th of July 2020?
I am.
Are you able to speak to the truth of the contents of the statement?
I am.
And is it true and correct?
Mr. Bolster, I have one very small amendment.
Thank you. What is that?
Page 5.
We could. What paragraph?
Page 5 is the modelling there, the assumption table to the right.
Yes.
The valuation capitalisation rate says 14.5%. It's an error. It should read 12.5%. My apologies.
All right. No, thank you very much for that. Finally, I withdraw that. Other than for that correction, the statement is true and correct.
It is.
It is. Thank you. Finally, Mr. McCarthy, could you please state your full name?
John McCarthy.
And is your position Head of Corporate Health, National Australia Bank?
It is.
And finally, if we bring up the bank statement, it's RCD *999 0386 0001. I take it you're familiar with that document that's styled a voluntary statement, correct?
Yes, I am.
And are you able to assert as to the truth of that document?
I am, yes.
And it is true, I take it?
It is true.
With the formalities out of the way, can we begin with a question to introduce the topic? Can each of you give us an overview of of your particular bank's involvement in the aged care sector, with an idea of the lending services provided? And I think we'll stick to the order in which we've gone. So, Ms. Horden, that means you've won the toss and you bat first.
Okay, great. Thank you. So, look, we are a major lender to the aged care sector, and we provide finance through both our institutional as well as our business bank. Looking at services we offer, there's four main areas which really are lending, transactional banking services, to a lesser degree leasing, and also financial markets.
Could you give us a brief idea of the distinction between the institutional bank and corporate and perhaps transactional banking, just so that we have that on the record, please?
Institutional banking tends to look after the medium to larger providers, so where a provider has minimum, realistically, 3 to 5 facilities, with lending 30 to 40 mil plus. Transactional banking refers to, I suppose, services provided outside of lending, which can go from day-to-day operating accounts to merchant-style facilities.
Right. And roughly in terms of the size of your borrowings or your client base, how significant is the aged care sector for the bank's overall position?
As of March, we had lending of approximately $2.3 billion, with probably the larger portion of that being originated out of the institutional bank.
Just in terms of your coverage of smaller providers, so one-off providers or 1 or 2 facility providers, what's your exposure or what's your involvement in that particular portion of the market?
It makes up a much smaller portion of our total book. As a general observation, providers with 1 to 3 facilities are less likely to meet our underwriting criteria.
We'll come to all of the detail of that later. We might turn then to you, Mr. Williams, but before we do that, Commissioners, I neglected to tender each of the statements.
I was wondering whether they needed to be tendered.
They could be tendered now, please.
Each of them separately or in one?
Either way, it doesn't worry me, Commissioners.
All right, well, perhaps if we deal with them in the order in which I have the witnesses here, the statement of the Commonwealth Bank will be Exhibit 2114, one of the ANZ Bank will 2115, the Westpac will be 2116, and the last one will be 2117.
Thank you, Commissioners. Mr. Williams, tell us about the Commonwealth Bank of Australia and aged care. Where do you see yourselves in relation to the aged care sector?
So not dissimilar to Westpac, the Commonwealth Bank is likewise a major financier into the sector. We provide a range of services that includes transactional banking type facilities. It's also inclusive of lending, both insofar as liquidity, short-term liquidity type lending, as well as development financing, and to a lesser degree, asset financing. We do that both in our business bank segment and also our institutional bank. Our institutional bank is focused on the largest providers in the sector, whereas our business banking segment would probably take up the majority of our exposure of the book. We have a portfolio of approximately $1.7 to $1.8 billion. Heavily skewed towards the business banking segment. And I would say insofar as the mix, it tends to be skewed towards multi-site operators.
Could you tell us a bit about your exposure to the 1 and 2 site operators? How does the bank approach that particular cover? Not in any detail, just a rough idea at this stage.
Look, we do participate in that sector, and I suppose when we look at the smaller operators with a reduced number of sites, it does present different risks when we are assessing the financial position as opposed to multi-sector operators. So I suppose it's just looking at the different levels of scale that those operators have, and also the risks that they are exposed to, where the smaller operators with either single or only a small number of sites just have less flexibility insofar as being protected from external shocks that might arise.
All right, thank you for that. Mr. Morris, we might turn to you. Where does ANZ fit? Where does ANZ position itself in terms of the overall sector?
ANZ, as a specialist health lending business, has provided finance to the residential aged care sector for about 15 years now. We currently lend to the sector through 2 national specialist health coverage teams, and these teams are delineated by size of customer lending requirements. Customers with lending requirements of above $35 million and above are serviced by ANZ Health Corporate and Institutional, which is the team that I lead. And customers with lending requirements below $35 million are serviced by ANZ Health Commercial. Both teams are staffed by specialist bankers with experience in lending to health-related industries. Much like the other banks, we provide a full suite of banking products and services to our aged care clients, namely transactional banking, bank accounts and cash management services, that is, corporate lending for development and construction, and other general corporate purposes. ANZ currently provides about $3 billion in debt commitments to residential aged care providers nationally, and our clients represent about 30% of the industry by beds and about 5% of the industry by operator.
Thank you for that. Mr. McCarthy, what about the National Australia Bank? Give us a brief overview of your position.
Thank you. National Australia Bank has relationships with a broad cross-section of the industry, ranging from single-site operators up to multi-site large-scale operators, and across the various different ownership structures of family-owned entities, not-for-profits, and ASX-listed companies. We currently have on exposure close to $2 billion in lending limits. The majority of that lending would be construction financing and development financing. We also can provide financing for acquisitions, some equipment financing, RAD liquidity lines, and sometimes financial markets. With that $2 billion in lending, 90% of that book would sit within the corporate health business, and that's where we have deep specialization. It's where we have the bankers that are relationship managers that have spent the most time looking into the sector. NAB also, with the sector, has support of a dedicated risk team that look at the aged care and health sector as well.
Yeah. Could I ask a broad question? Where do you see the aged care sector overall? Where is it going in the future? We might go around in reverse order this time. Mr. McCarthy?
With the aged care sector, the demographics see continued growth within the aged care sector. There's going to be continuing demand for the sector with the aging population that we have. And NAB is supportive and kind of continuing to look forward to supporting the sector.
Do you see support? Do you see performance at all levels of the sector? That is, the larger multi-site operators, medium-sized operators, and then the smaller providers, the one or two facility operators. Do you see the future as being the same for each of them?
No, I don't think it's going to be the same for each of them. I think over the course of a number of years, it's become harder for smaller operators within the sector to be able to I suppose look confidently into the future that they can sustain additional costs and to deliver a care model that the community requires.
What's your view about consolidation? It seems to be increasing fairly rapidly, and it seems that the targets of consolidation are single and smaller providers. Do you have experience of that process, and what can you tell the Commission about that?
Yes, we do have experience of it, and it has been a recent trend over the last number of years. And for the reasons I outlined previously, it is becoming tougher for the smaller site operators to deliver a sustainable business model and to deliver, and with that delivering the high quality of care. I can see that continuing into the future, and I do see it being particularly challenging for those smaller operators to continue to thrive and flourish within the sector.
Mr. Morris, do you have a perspective about that? Why is consolidation occurring, and what's behind it? What needs to happen to stop consolidation?
Sure. I guess over the last few years in particular, we have observed a gap between lower income growth across the sector and higher cost wage growth. So despite steps taken by operators, this has resulted in a general decline in profitability and cash flow of our aged care clients. I'm sure that the same trend is evident in ACFA and Stuart Brown reporting that that the Commission has seen. I guess what we've also seen is in respect to development funding, we've observed an incremental shift from Rads to Dapps. So this trend, in addition to longer trade-ups and softening occupancy, has resulted in an increase in instances where development debt has not been able to be repaid by the maturity of facilities. Now, these risks, they're more acute for single site operators because they're less able to offer a competitive service at a lower cost with this declining margin, because with scale comes diversity, and we've found larger operators are able to weather those types of risks in this environment.
Mr. Williams, what's the Commonwealth Bank's position about these issues?
Council, there's probably no other industry that the Commonwealth Bank supports where I would be able to say that more than 50% of the operators in the industry are either marginally profitable or loss-making, and I note that that's been referenced in a number of reports presented. We would agree that the profitability and performance of a number of operators is quite challenged. When we look at the sector, we are focused on the top quartile of the sector insofar as performance for very obvious reasons, but it's quite a unique. I couldn't say that about any other sectors that the Commonwealth Bank participates in, where such a large proportion of operators are structurally challenged insofar as their long-term operating cash flow.
Well, let's take that point because it's a very interesting point. What makes it then attractive for the bank to be involved? If things are as bad as that, why does the bank remain involved in aged care?
I think as was mentioned earlier, the demand for aged care facilities continues, and we would certainly see that continuing. There are scale operators, the larger operators, who we see are profitable, performing well. The costs, as one of my colleagues mentioned there, are pressuring the margins in the sector, and that may prove in the longer term, if those margin pressures continue, will make the support of the industry far more difficult. But at the moment, we would see certainly the demographics are positively disposed to strong demand. It's as has been noted, the costs escalation relative to the income hasn't been keeping pace.
What on the revenue side? I mean, I imagine that the bank keeps a close eye on the accounts and the books of its customers. Those that are struggling on the revenue side, what do you put that down to? What are the challenges that the Commission needs to be aware of on the revenue side in aged care?
Well, I think it's certainly the growth in the revenue side is not keeping pace with the growth in the cost base. And I think it's the structural pressures on the cost base which is challenging the revenue line. And it's very much about the ongoing sustainability of the cash flow of operators. When we look at these sorts of things, it's we want to support those operators who have viable businesses that meet the costs of the services, but also can generate long-term sustainable cash flow.
All right. Ms. Horden, what's Westpac's perspective about these issues?
Look, I would probably, I definitely agree with everything the other banks have tendered. I think, looking at the impact on performance, I think we really look at this as three key reasons. And as mentioned by Chris, it is really wage rises outstripping the indexing of income, but also the significant increase in regulatory activity and the costs associated with this. And I think this is where scale has really played an important part, as we've seen the larger providers are better positioned to absorb these costs with a more diverse portfolio. And, as previously mentioned, we have seen downward pressure on occupancy as well as a shift on the Rad and Dapps mix.
Thank you. Changes to ACFI that were introduced in 2016 had a significant effect on the overall revenue of aged care. Is there any perspective that you wish to provide us as to how that has played out and how that has trailed through the system over the last 3 to 4 years? Perhaps you might go first on that, Ms. Horden.
Westpac observed that it had quite a significant impact in the sector's financial performance, with quite a significant decline really from FY18 onwards.
Mr. Williams? Yeah, I think I'd endorse that. Certainly the performance from 2018 or thereabout has got a lot more challenged.
Mr. McCarthy?
From NAB's perspective, we've seen the same trend across our client base.
And Mr. Morris, is there anything you wish to say on that topic?
Yeah, ANZ would have nothing to add to that.
What's the ANZ's position on that revenue issue? I mean, you have a single purchaser of aged care services in the country. It's the Commonwealth, pays through ACFI for residential aged care. You have a growing demand with many people that need aged care. What's the revenue problem? Is it as simple as there is simply not enough revenue going into aged care? And if so, how short is it from the bank's perspective when it comes to providing an attractive business proposal for lending purposes?
Sure. I guess when we look at revenue, it is made up of two key factors, being ACFI, which is the government funding instrument, and resident contributions. And to be honest, we've actually seen both of them in combination not keep pace with the cost escalation. So we see them as two factors, both not keeping pace with costs for which it is provided, which is care, and resident contributions and the level of those also not keeping pace with that cost escalation, which is resulting in the margin erosion that we're seeing and less cash flow available to the operator, which then, of course, impacts adversely bank appetite to the sector.
All right, well, let's move on to a different topic, or a slightly different topic. Home care would seem to be a pressure on residential aged care, at least from a financing point of view. If more people choose to stay at home to receive aged care than go into residential aged care, what is that going to do to this particular market from the financiers, from the banker's perspective? Mr. Williams, we might start with you first. Is home care a threat and a risk that you look at?
I'm not so sure I'd necessarily see it as a threat. There's probably an increasing desire of people to stay in their homes longer. That will impact occupancy rates if that is a long-term trend. But equally, I think the demand demographics vis-a-vis the amount of available accommodation are still very compelling. So even though there may be a trend towards people staying at home longer with home care, I think still the demographics are very much heavily skewed towards strong demand for available accommodation.
Let me throw another factor into that equation, and that is COVID-19, which we're starting to see a trend of occupancy going down, people being reluctant to go into residential aged care for fairly obvious reasons. Is that going to be a pressure, do you think, on overall occupancy? Mr. Williams?
I think, Council, it very much depends whether this is a long-term structural shift or whether it's if you look through to the other side of the pandemic, whenever that period is, we would be of the view at the moment that that it's not necessarily a long-term structural shift, but of course, if that is the case, then the demand on RADs being released as occupancy reduces does put an awful lot of pressure on the sector. If that is a long-term structural shift, I think there's a question mark as to whether or not that is the case. And that's something that certainly when we look at financing in the current environment, it's a very important consideration.
Ms. Horton, do you want to add anything to your question, to your answer to that question when it comes to the issue of COVID-19?
Look, I think in line with what Chris said, obviously we're assessing and looking at options of where we are at in regards to timing of the pandemic. And, you know, we feel it's very early or challenging to make a call on the potential longer-term liquidity impact. As of today, we don't consider our book under a heightened level of stress, and this is something we are under constant monitoring, especially from occupancy and liquidity point of view. We definitely have seen an impact on occupancy, and this is a trend that has continued really pre-COVID. So it is something we monitor very, very closely, but as of today, we still consider our bank to be under a satisfactory level.
If occupancy trends continue away from residential aged care, what does that mean in the longer term? From the bank, from the ability to raise money?
It definitely has an impact, as does, I suppose, the Rad Dap mix. And
all right. We'll come back to Rads and Dapps later. We'll come back to liquidity and prudential things later. But I just wanted to get this overall view about occupancy and where you think occupancy is going. Perhaps, Mr. Morris, you might continue with that issue.
Yes, Mr. Bolster. We believe that there is a proportion of the population that needs residential aged care and cannot be cared for at home. We think that in combination with the ageing of the population, namely the doubling of the population above 85 in the next 20 years, will drive demand for residential aged care services. I would say, though, COVID is certainly putting pressure on operators, particularly with Metro Melbourne operations, and we're watching that really carefully, particularly seeing lower levels of occupancy in that area. And of course, with that comes liquidity risk, as particularly RAD residents may not be able to be replaced with incoming RAD residents or admitted at all. So we are watching it very closely.
Mr. McCarthy, where's occupancy going in the medium to long term, do you think?
In NAB's view, the occupancy has been trending downwards, and clearly as a result of COVID, that's been exacerbated, particularly within Metro Melbourne. I do think our NAB's view is that there is going to continue to be a demand for aged care services. I think the question really comes down to is the entry point into residential aged care against being looked after at home. And we see that occupancy levels, whilst it is clearly hard to predict, we do see continued support for high occupancy. However, I do think that it is a case of residents will be entering into facilities at a later stage in their life.
All right. Could we turn to one particular segment of the market that's extremely important for a lot of people, and that is coverage in regional, rural, and remote areas? Could you give us an idea of your exposure in those areas and your view about where that particular market is going? Perhaps, Ms. Horden, would you like to go first?
Westpac definitely does support providers in regional and remote Australia. I would make the observation a lot of the exposure that we would have would be through not-for-profits and larger providers who have facilities in more regional and remote Australia and have the benefit of more diverse portfolios and also income streams. Through our business bank, we also have numerous exposures in larger regional exposures, communities, but I would probably note that some of the challenges we do find within regional and remote areas are, there is a significant profitability difference we observe between these areas and more key metro areas, as well as challenges such as liquid house prices and really securing the workforce in these areas.
What about the capacity of providers to extract RADs from incoming residents? What's the difference in the regional, rural and remote context?
That is something we view as a key challenge and linked to both, I suppose, the value of the house prices, but also how liquid the house market in many of these areas are. So we do find that as a key challenge.
Do you find that RADs are negotiated down in rural, regional and remote areas?
That's
or-
something I'm probably not in a position to comment on.
All right. Mr. Williams, what's the Commonwealth Bank's position when it comes to regional, rural and remote areas?
I think when it comes to regional and remote locations, the harsh reality is that the cost base of operating facilities in those locations is even more structurally challenged than it would be in metropolitan zones. When we do provide financing, it is to typically multi-site operators who have the benefits of diversity across so the costs that arise typically are whether it's just staff in those regional locations. I think the other thing, as I mentioned, that the profitability of the sector is challenged. It is even more challenged when it is in regional and remote locations.
All right, Mr. McCarthy, your perspective on that topic?
NAB's perspective is that we do lend to operators that have regional sites. Again, typically we'll be part of a larger and more diverse group. The challenges as have been outlined are there to see. It is harder to attract higher valued RADs. It is also the depth of the market there with regards to if should a resident pass away, the ability to have a new resident come in a timely fashion due to just the general market and the depth of that market can be a challenge, and also that ability to attract high quality staff to provide the level of care that's required can also be a challenge, again just due to the natural depth of the market within regional areas.
And finally, Mr. Morris.
ANZ certainly provides banking products and services to regional operators, but much like the comments made previously, they are usually part of larger not-for-profit or larger national providers. We'd certainly consider lending to regional operators where they met our lending criteria, but some of the challenges we would certainly share with the other panel members.
Just to help me with this, assuming a single rural regional operator cannot satisfy each of the four major banks, do the options for finance necessarily involve a greater interest charge if they were to go to other levels, to smaller, medium-sized banks? Is it going to be more expensive for that provider to get funds if they can't get it from the four big banks?
Look, it's certainly hard to comment directly on that, but it would naturally follow that would be the case, Council.
Yeah. All right. Let's talk about the way in which you operate in terms of a borrower and the prudential or liquidity steps that you take to monitor the performance of particular borrowers. You will understand this is of some significance to us because the Commonwealth, through its regulator, has a supervision of the RAD balances and the bonds that are made available to providers, and that providers ultimately have to repay. When you lend to construct an aged care facility, to what extent do you monitor the liquidity of your borrower going forward? And to what extent do you make them report on their liquidity to you as the loan develops over time? Ms. Horden?
So look, obviously prior to lending, we would have quite an array of information that we would require from an operator. So as standard to any lending criteria, we would be requesting audited accounts, budgets, management accounts, ongoing covenant compliance, specifically for the aged care sector. We would also look for a copy of the annual prudential compliance statements. And more specifically, in a development process, we would be requiring ongoing construction reports. And then once open and during the trade-up period, we would be closely monitoring, sometimes up to on a monthly basis, both RADs and the occupancy uptake.
Yeah. So I take it in the institutional context where you're dealing with a very large group of providers where there is far less prudential risk that you may not want as regular reports as you may for a smaller provider. Is that right?
That's correct. In looking at the frequency of reporting, it's very much linked for us internally to risk grade. So obviously our higher graded clients, it would more likely be quarterly or biannual. We're looking at the smaller providers who are more exposed to that trade-up period, especially during that trade-up period, we would look at more frequent reporting.
And when it's frequent reporting, what is it reporting of? It's obviously not their full accounts, but
no.
Give us a sense of what it is that you want to hear from your borrower on a regular basis.
So really, it would be looking at their management accounts, so basic P&L, cash flow, as well as, I suppose, looking especially in that trade-up period, what the RAD-DAP mix is and the percentage of occupancy at any one time to ensure that, I suppose, it is tracking in line with what our expectations of that project.
All right. Let me introduce a concept that we are looking at in terms of prudential regulation, and that is a form of continuous disclosure to the Commonwealth of the liquidity position of providers as a means of ensuring that there is no risk to the Commonwealth and more particularly the residents themselves and their families of their RAD balances.
Yeah.
Continuous disclosure is effectively, can I suggest, what goes on between you and your borrower? Do they continuously disclose their liquidity position to you?
Looking at the ongoing compliance covenants, a liquidity covenant is one of the key covenants that we do often require for this sector. So, as previously mentioned, it is likely that they would be disclosing this to the banks on either most commonly a quarterly or biannual basis.
All right, we might move to you, Mr. McCarthy. Everything that Ms. Horden has said so far, I take it's the position with the NAB?
No, the position wouldn't differ too much. I would say that having quarterly reporting or having reporting on the actual liquidity position in the trade-up is not something that NAB typically would require. We get comfortable with at the outset of a development or a transaction. We get comfortable with what the stated liquidity strategy is of our particular client and get an understanding as to how the board or the management are comfortable with that and would use that as our starting position. And then in the trade-up of a facility, what we would require is receipt of their RAD register. So that's a receipt of it's a document letting us know what RADs are coming in, and hence that they're being applied in the correct way against our facility, whether it be the construction facility or the RAD liquidity line, and also it would allow us to see any RADs that are leaving, and hence we would be able to kind of work if there's any unusual trends with that. We would have regular conversations with our clients on how that may impact on their liquidity.
And how often do you ask them to report typically?
Typically, it's on a quarterly basis.
Mr. Williams, is there anything you wish to add to this discussion?
Sure. I just add that so we would look at it the reporting requirements between the development financing of a smaller smaller number of sites relative to a large national operator, slightly differently. But so when we look at a development financing, we would employ valuers to look at the overall property, specialist valuers in the aged care sector. And we would obviously look at a whole range of issues as to the development of the site, including the construction aspects, and then the price points with the RADs are being set at. Insofar as a developed or as a series of developed sites, we would look at where we're providing liquidity for RADs. We would typically expect to see a covenanted amount of liquidity. That's invested money, cash, and or available lines, and would want to see that reported on a regular basis and would set covenants around that. We would also look at a range of other covenants, so perhaps insofar as the costs relative to wages and such forth, insofar as monitoring the actual performance of the business. We would look both historically, but particularly on liquidity. We would be asking customers typically to run various scenarios of liquidity outflow.
Thank you for that. And what sort of frequency could a borrower at the CBA expect when these issues require reporting?
I think if it's a liquidity type line, it would be at least on a quarterly basis in the normal course, and if it was a construction development financing around a particular site or two, it would be monthly, insofar as the construction progress more so.
Yeah, sure. And Mr. Morris, how do you approach the overall issue of liquidity and the reporting of it to you as a bank?
Liquidity is a key part of our risk assessment when lending money. In most cases, we impose a liquidity requirement, and that could be anywhere from 2.5% to 10% of an operator's RAD liability, and that would usually be in the form of debt facilities that we may provide or available cash. But of course, we do seek to understand the operator's liquidity strategy, as mentioned before, in particular understanding historic and forecast RAD and DAP cash flows. So they're probably the key things. As far as the frequency of reporting, it's usually quarterly, although it's usually determined on the requisite risk of the borrower. You would expect more frequent reporting, of course, for those groups that are higher risk, and the converse of that for those that are not. There's also informal reporting that we are speaking to our clients quite regularly as well, and that continuous disclosure point that you raised before, we usually come about it in that way.
Right. If you could each bear with me for a moment and have a look at a proposition that you may have seen. If we could bring up, please, the prudential regulation propositions, proposition PR3 in particular, if that could be boxed. It's on page 21 of the document. The box proposition, please. That could be highlighted. Only the bolded section, it would be useful if that could pop up. Thank you. Thank you. I assume each of you have seen proposition PR3. Perhaps we might just... the Commission, I think, would value your assistance about the phraseology of the trigger that should be imposed for continuous disclosure in the context of liquidity to protect RAD balances. And you'll see here that we have proposed a draft proposition that says that if an aged care provider becomes aware of material information that affects the ability of the provider or any contractor providing services on its behalf to continue to provide aged care that is safe and of a high quality to individuals to whom it is currently contracted or otherwise engaged to provide care, I'm sure that the triggers on liquidity look very different in the bank's documentation. Could you give us a sense of what it is that will draw out a borrower to have to disclose their liquidity to the bank? Perhaps Ms. Horton, are you familiar with the sorts of conditions that are engaged in this context?
Well, ultimately, the client would disclose this information to us through their quarterly or biannual compliance certificates. So obviously they report both on their covenants, but also that they do have information undertakings that they also, we have outlined in all of our agreements with key pieces of information that they're also obliged to share with the bank.
And what do those undertakings go to? Do they go to a change of position on their RAD balance? Is that something that you would expect them to disclose or require them to disclose?
There would often be a threshold rather than a specific amount. So occupancy and call it RAD movements often would play a part in this, but again, it does differ from client.
What are the markers, though, that are important from the bank's perspective on liquidity? Is it just liquidity and just occupancy? You obviously can see what's happening in their bank accounts.
No, so as touched on, I believe by Chris, looking at the covenants that they're likely to have, it would also have most likely a debt style covenant, such as debt to EBITDA, as well as a service cover.
Mr. Williams, are you able to assist us with the sort of covenant that could be used or could be drafted to engage this sort of issue?
Sure. I think probably the variance that we would be very specific. So the reference to providers becoming aware of material information. What is material is obviously it's very broad in its nature. When from a banking point of view, we would be very specific insofar as setting a covenant, and that just to use a benchmark, it might be 10% liquidity, but that might be plus or minus depending upon the nature of the provider and their financial position. But we would be very specific insofar as setting covenants. At which point, typically a financial indicator covenants, it could be an interest cover covenant, it could be an overall leverage or debt to EBITDA, as Thea mentioned, but a suite of covenants that seek to provide a early indicator of a change in the profile of the borrower. So we would be probably very specific in our documentation, and of course we would be getting regular reporting around that. So it's probably more the specificity of financial indicator covenants that we would set.
Mr. McCarthy, is there anything you wish to add on this particular topic? Do you have another way of doing it, or is it fairly similar for the NAB?
From NAB's view, it's fairly similar. I would say that we have the benefit of working very, very closely, I suppose, on a near individual basis with each client to be able to structure their covenants in line with what their business strategy is, what they're looking to do, so that there is, I guess, no unintended consequences of that covenant, because it is breaching a covenant is quite material. So we do work very, very closely on that individual basis. I would say as well, just with liquidity, is that if you look at the liquidity, it's liquidity is a lag issue. So it's as a result of something happening within the business. So we would take comfort from our covenants that we'd have around some of those lead indicators being occupancy in particular, and really track that very, very closely, particularly for our clients that would have a high debt exposure or are looking to might have some core debt within their business or looking to trade up their facility. And whenever if there's a drop in occupancy for whatever reason, that's where we really start to dig into the impacts of that that drop in occupancy and the knock-on impact of liquidity, and if that continues in a trend, what does that mean for future liquidity?
All right. What other lead indicators should we look at, do you think, in this context?
From the liquidity side of things, it does come down to that occupancy, and then I guess when the occupancy, you have a certain occupancy number, it's the Rad Dap mix between, I suppose, the trade-off between one resident who unfortunately passes away, who has paid a Rad, and that Rad is refunded back, and the next resident that comes into the facility pays a Dap. So again, that Rad Dap mix is something that's very important and would be seen as well as a lead indicator towards liquidity.
Well, just going back to something you said earlier about the liquidity plans that you looked at when you were approaching a borrower's application, do you typically look at the documentation prepared to support the prudential standards that are in place in aged care about the formal liquidity plan that providers are required to account for under those particular regulations?
I would like to think that it's a core part of our due diligence for lending applications, yes. And
tell me, do you see many of those liquidity statements or analyses from potential borrowers?
Me personally, I don't see a significant amount of them. My relationship team on the ground would see them, and our risk team would also have visibility over them.
Does anyone else on the panel look at the way in which the provider proposes to meet their prudential obligations under the prudential standards imposed on them by the Commonwealth? Start with you, perhaps, Mr. Morris.
I don't know them in detail, but I think what you're referring to and maybe what you're looking for is more of a forecast cash flow. I think the issue with covenants they are backward looking. So a forward forecast cash flow can provide an early warning sign as to what the proposition is seeking to cover there.
All right, thank you. Just on, we hadn't got to you about the sort of leading indicators or the way in which one could approach continuous disclosure to trigger action in light of proposition PR3. Was there anything else you wanted to say about that?
Nothing really to add to what the panel has said, except possibly with that forecast cash flow, because that's really that really goes to the heart of liquidity. So understanding what forecast Rads and Dapps look like, and does the operator have sufficient liquidity?
And what sort of change in forecast cash flow would you be looking at? What would ring an alarm bell for you?
Where the operator is forecasting that the cash outflows don't meet the incoming cash flow, and that would usually be expressed most acutely on an operator's cash flow statement through the change in RAD and DAP elections and value.
Yeah. All right. Was there anything anyone else wanted to say then about that last issue? Mr. Williams?
Council, Chris, it's probably the only add I would make is that when we look at the providers, we don't just look at the single license holder, we look at the totality of the operator, particularly where there's multi-sites. So that's probably the other slight distinction, that we don't have a narrow focus per se. We would have a total view across the range of activities the operator has.
Ms. Horton?
Yeah, no, agree with both Sam and Chris's observations there.
Can you help me with a sort of change in forecast cash flow that would set off an orange light or a red light at the bank?
Well, as mentioned, forecasts are one of the key requirements, and we do request ongoing updated forecasts, especially if the provider would view that there was going to be a material change. So really, to us, key is obviously if the outflows were outweighing the inflows, which is why we very carefully continue to monitor both the RAD-DAP mix, because that obviously can have a significant impact on a provider, as well as key occupancy levels.
All right. Well, let's turn then to RADs and Daps, because they seem to be the most important feature of bank funding for aged care.
Mr. Bolster, just before you do, can I just pick up the point that I think Mr. Williams was making about, well, indeed all of them are making really about forecasts. Is it safe to assume that all of the providers that you deal with will have forward budgets, and that they review their forward budgets internally at least quarterly, if not more frequently? Is that a safe assumption?
I think from the Commonwealth Bank's point of view, yes, that would be a safe assumption, and they are discussed with the customer on a regular basis. Whether they are updated dynamically every quarter partly depends on the circumstances, but I think that's a safe assumption. And if they didn't have that ability to establish some forecasts, we would run our own forecast, but it also would go to the expertise and governance of the particular operator.
Yes, I suppose I should have really directed somebody to answer the question rather than have all four of you wait for the first one to pipe up. But I mean, I don't need the question answered 4 times. So perhaps just staying with you, Mr. Williams, and the others might chip in if they disagree. But I'm assuming that it's a very rare case where the provider would not have at least an annual forecast of its expected future position.
That is absolutely correct, and it would not just be an annual. We would probably expect it to be 2 or 3 years out, and then we might debate the underlying assumptions. Management may have a certain set of assumptions embedded into their financial model, and the bank may have a slightly divergent view. But yes, that would be an expectation of borrowers in the sector, that they would have a functioning financial model that would be able to be updated on a regular basis, yes.
And I'm assuming that not all of the providers would have a standing audit and risk committee. Is that your experience as well, or is that just my guesswork?
Oh, look, I think, I probably can't speak to some of the smaller operators where I suspect that's perhaps not the case, but certainly the larger national operators, they do. My experience would be that, yes, they would have typically a committee that would oversight their budget and their overall risk profile.
Yeah. So from a financial point of view, that is to say, if you were putting on our hat, but informed by your experience and knowledge, would it be kind of sufficient to get an indication about whether any provider is likely to be in distress if the requirement was that they should notify the system governor if in any 3-month period the projections were, say, 10% or 15% or 20%?
Sure. I think that would be reasonable. I think the level of financial sophistication, I suppose, would diminish as you get to the smaller operators whereas the larger operators would have scale. But even at the smaller operators, you would expect them to have a degree of financial discipline if we, from a banking point of view, were lending to them.
Yeah, thank you. Do any of the others want to pitch in?
Commissioner, I would say that from the bank's point of view, or from NAB's point of view, the reporting that we get, because we have a diverse client base, and not all of our clients borrow money from us, and hence the reporting requirements. There would be no reporting requirements from, for the bank, because they're usually tied into loan documentation. So I guess the question kind of goes to whether those operators that are investing their refundable accommodation deposits into capital financing themselves, their own projects, as to whether they maintain the same level of reporting standards as they would have to do towards a bank, because certainly from NAB's perspective, we wouldn't have visibility over that side of things.
Yes, I understand that. I think PR3A is really focused on, and I think maybe Mr. Morris indicated, is really directed to the regulator having some sense of continuing financial viability, rather than necessarily whether the building is being constructed in accordance with the building plan. And for us, the critical question is, what should we be identifying as the trigger point that should be notified to the regulator, so that the regulator can ensure continuing financial viability? It's really that we're sort of seeking, or I'm seeking at this stage, some sense of where you, as people concerned about financial viability, might indicate that we should go.
Just to develop that theme, I take it most borrowers would have a relationship manager, and there'd be fairly constant communication in the situation where there is this sort of exposure. Am I right in thinking that, Ms. Horton?
That is correct. So within Westpac, all of our relationship managers are specialised health and aged care specialists, as are our analysts as well as credit officers.
And I take it that's the same in the case of the other banks, and so there'd be regular contact even if there wasn't monthly reporting. Is that correct, Mr. Williams?
Correct, that's correct.
We might move on then to the central role of Rads and Dapps in capital financing for aged care. How important is the RAD when an aged care provider seeks to obtain funding to build a facility? Mr. Morris?
Thank you, Council. RADs are certainly fundamental to aged care lending as it currently stands, both as a funding source for the sector and as a repayment mechanism, as you've highlighted, for development lending from banks. In our witness statement, we did present two models to highlight the importance of RADs versus Dapps in aged care lending. I guess what we sought to show, our high-level analysis, that ANZ would not have debt appetite to fund the average ANZ's client transitions to Dapps in isolation. And so particularly when it comes to construction, we would usually expect that our debt would be repaid from those incoming RADs within a reasonable period of around 3 years. But it is also important to the ongoing viability of the sector, given the large amount of RAD liability that does sit on an operator's balance sheet. And so there's two risks there. There's less liquidity available to a provider if that RAD-DAP mix would change. And of course, you would see a reduction in bank appetite to fund new developments if those RADs weren't available as they have been in the past.
Would the price of funds go up if RADs were not available?
That would certainly be one impact, but then there is a certain point where pricing will not defray the ultimate risk, particularly when liquidity is at the heart of the issue. And therefore, I think what you would see is banks moderating their appetite, as ANZ has done over the last couple of years.
And is that because of the trend towards Dapps?
As covered before, we would say both on the operations side, we've seen that margin erosion, and we're seeing a very slight change in our client base from RADs to Dapps. So at this point, we don't see it as a large issue, although that being said, forecasting out ahead, as we've just been discussing cash flow, we do have concerns with falling occupancy and continued change in RAD and DAP preferences that liquidity will be more of an issue for operators.
Mr. McCarthy, is there anything that you wish to add to that, different to the previous answers?
In that view, we wouldn't have a huge amount to add to that. It's RADs are paramount of paramount importance to financing. Without RADs as a primary source of repayment for a debt, the banks would rely on the future cash flows and the profitability of the operator to be able to repay that debt. Typically, that would lend to probably a longer tenor of that debt and a higher repayment period, and hence that would slow down, I would suggest, capital financing into the sector, and it would provide extremely it'd be extremely challenging for financing into the sector without RADs.
Ms. Horton, was there anything you wanted to raise in addition to that?
No, I think just to really add to that is the key benefit as a bank that we see as a RAD is it allows us to lend significantly over what the operating cash flow allows for. So obviously, as we see a continued shift in the RAD to DAP mix, that this is having an impact on the bank's ability or capacity to lend to the sector.
One of the things about RADs is that they don't seem, other than having the price limit of $550,000 with the ability to apply for a higher limit if you want, they don't seem to be regulated in terms of the amount, given the location, the client mix, the cost of building, the likely cost of capital to build in that location. Do you see scope for RADs to be regulated by reference to some form of industry cost of capital with variations depending upon the location? Particularly, I'm thinking about the rural and regional and remote areas where there is less ability for someone to sell their house at the price that's linked to the RAD, and the costs of building are likely to be more significant in those locations. Mr. Williams?
Yes, Councillor. I would say I think it's an important distinction to note that RADs are an interest-free loan provided to the provider, as compared to financing that we would provide would be interest-bearing. So that's a very important shift. And so I would say that whilst the RADs have performed a very valid role in the industry by promoting investment into new developments, and that has been a very positive outcome. The shift away into a interest carry provided by commercial banks, at some point someone will have to pay for that cost as opposed to an interest-free loan. And that's probably the very important distinction as to there will be a cost if the commercial banks are providing it, and that someone will have to pay that cost.
Mr. Morris? We can't hear you, Mr. Morris. I'm sorry.
Apologies.
Oh.
Could you just repeat the question again, Council? Sorry, I had a bit of feedback on my line.
The point that I was getting to was that should there be an approach to capping or monitoring the prices of RADs that has some relationship to the cost of building in a particular area, and I'm thinking particularly in rural, regional and remote areas, and also having regard to the cost of property, of residential housing in those particular areas where people have to sell their house in a rural town in New South Wales to afford to buy a RAD. Should the RAD be regulated by reference to the constraints that are in play at that location?
We would expect, I guess, the market to be able to sort that out. We probably don't have a house view on that particular point, but it would naturally follow, except for in thin markets, that demand for that particular product would be influenced by those factors you described.
Right. We'll come back to thin markets in a minute because there's a question I need to ask. But Mr. McCarthy, did you have a perspective about controlling RADs? What would the bank's position be if there was some regulation about how much could be charged in a particular location?
NAB doesn't have a very different view on that. I would say that it's simply to allow the market to work in the way that it is currently working, and allow operators to have the ability to charge higher rads where the demographics allow it to do so.
All right. Mr. Williams, did you wish to add anything on this topic?
No.
All right. Just in terms of the propositions, there's another proposition I'd like to take you to, and that is the proposition FF4 on page 4, funding arrangements in thin markets. Page 4. I take it each of you have seen this particular proposition?
Yes.
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 If the funding approach were different along those lines, would it make lending to borrowers in those particular markets more attractive to the banks? Ms. Horton?
I think it would need to come down to the detail of what those funding mechanisms were, but we broadly do agree, and it's in line with our submission, which really does outline the challenges of funding to some of these thin markets.
If we add to the mix proposition FF2, which I'm sure you've also seen, that we move to a funding model where there is a authority to determine the actual cost of operating in a particular location, where there are loadings by reference to remoteness, very similar to the model that's used to fund public hospitals across the country. If there were a recognition of the extra costs in rural, regional and remote Australia, and there was an uplift to truly recognise those costs, would that provide more of an incentive for the banks to be involved in developments in those areas?
Looking at this, you would assume that those incentives would add to the ongoing cash flow. The concern we potentially would have, especially when you touched on developments, is obviously our ability to receive repayments on those development, which is still fundamentally linked into the ability to raise RADs to be able to get that debt cleared off in a shorter time frame.
All right. All right, Mr. Morris, do you wish to comment on the combined effects of propositions 2 and 4?
I guess what we would say is we need to better understand how they would impact individual providers. Obviously, there are a number of relevant factors ANZ considers when lending. If a financial return are not made on these additional services, it wouldn't induce further investment. So as Thea touched on, if it did add to in isolation, the cash flow to a requisite operator, then in isolation would assist in attracting bank debt finance. Of course, noting though, it is not in isolation and there are a number of other factors which we need to consider.
You'd agree with me though that as matters stand, providers are not funded to enable them to meet the direct and indirect costs associated with delivering high-quality aged care services in their particular location. You'd agree with that proposition?
We can only see what we've seen in our client cohort, and we have certainly witnessed that margin erosion. So that would naturally follow, Council.
Okay. Did anyone else wish to add to that before we move on to another topic?
Yes, Council, Chris Williams. Probably the point I would make on this is if it is solely a cost recovery model, that may not be sufficient to provide an incentive for capital to flow to that operation. So if it's simply recovering the costs, if there was a suitable return on the capital investment achieved, that would provide an incentive for investment. I think that would be the add.
I think you can factor that assumption in. I think that the proposition is really designed to ensure that it incorporates at least recognition of what those costs are, and that it recognises where those costs are going to be incurred and the particular price that's necessary, and the price being set independently. Do the banks have a view about the overall approach of having an independent authority determine prices like the hospital context? Do you see advantages in that? Who wants to go first? Ms. Horden?
From Westpac's point of view, we don't have an issue with the authority, but for us it very much comes down to how it would be implemented. Our broader concern would be ultimately, if any regulation put a cap on profitability, this could lead to obviously an impact on both investment and potentially competition within the sector.
Anyone else on this topic?
Council, we would just add to attract financing and investment to the sector. I think if we could demonstrate stable and consistent financial performance through this mechanism, then that it would be of assistance, yes.
Mr. Williams?
Yeah, we from the Commonwealth Bank's point of view, we would see that a well-functioning regulator oversighting the quality of the care, the efficiency of the operations, and the achievement of a reasonable return would be absolutely conducive to a well-functioning industry.
Thank you. I want to move on to one.
Mr. Williams, can I ask you whether the banks have any sense of a reasonable return in this sector?
I think on what a reasonable return I would have to leave to others, whether it's a 5, 10, 15% type return, I think is for others to determine. But I suppose I'll answer it in this way, and it needs to be sufficient to encourage investment. And I think that's the key, and that sufficiency needs to cover both the cost of the operations and the capital invested and the risk associated with investing in the sector.
Thank you.
Mr. Williams, on that topic, how would you suggest an independent pricing authority should approach estimating the reasonable required return for a provider?
I think that one is probably outside my pay grade, unfortunately. I think to determine that one, I think would be for other experts to opine.
Is anyone else being paid enough to answer that question?
Unfortunately not, Council.
All right, thank you.
No.
My last topic is about reverse mortgages. And we've heard some evidence over the course of the last week about encouraging people to make more of a contribution to their aged care going forward. Reverse mortgages seem to be one option in which they can do that. What's the bank's position in relation to reverse mortgages? I've seen and I've spoken to it. You understand there's reluctance to be involved. Why is that? What's the problem with the reverse mortgages? Ms. Horden?
Look, as I think we mentioned in the pre-hearing, this is something Westpac doesn't originate, and typically we have had limited appetite for this product. This product area is something that sits outside of my business unit, but I think in regards to the reluctance, I think one factor would be you are dealing with individuals at a very vulnerable time in their life, and I think that historically has played in to the bank's reluctance to consider reverse mortgages.
Mr. Williams?
From the Commonwealth Bank's point of view, we did provide reverse mortgages. We announced in October 18 that we would discontinue the provision of reverse mortgages and formally stopped originating them in January of 19. We have around about $1.1 billion of reverse mortgages still on our books for around about 10,200 customers. We decided, and I would say typically the loan size of those reverse mortgages was around about the $75,000 to $100,000. The reason, there was a number of reasons we decided to withdraw the product, but can I say that perhaps the overarching reason, and whilst there's absolutely an element of vulnerability, we see that there is ways and means for the legal fraternity to protect people in vulnerable situations. What we found with the product in particular was where the loan was taken out for a reason other than for the benefit of the homeowner is where disputation arose. And if I could perhaps unpack that a little in the form of an example, if perhaps, say, an elderly mother, father decided to take out a reverse mortgage for a son or daughter to either pay for investment in a business or a failing business or their own financial difficulty, and upon the passing of the homeowner, other beneficiaries from the estate came about to challenge the validity of that. So our overarching reason was when the purpose was for a purpose other than the benefit of the homeowner was where we found a lot of disputation arising. And I think the other element around reverse mortgages is, look, I think there is generally a societal expectation upon the passing of elderly family members that the home is part of the inheritance and arrives in an unmortgaged fashion.
Just on that, just one question about that. To what extent were people borrowing for their aged care?
I probably couldn't give you a sort of a percentage or so, but what we found was it was often for purposes other than their own benefit.
Thank you. Anything from you on this topic, Mr. Morris?
We don't offer this product at ANZ, largely as it falls outside of our risk appetite. I'd have nothing more to add than that, Council.
And finally, Mr. McCarthy?
Likewise, Mr. Ballister, it's not a product that we offer for the reasons outlined. It's outside of our risk framework.
All right. Thank you, Commissioners. I have no further questions.
Yes, thank you. I'd just like to sort of ask a really general question. Again, I don't really need 4 answers, but it'd be useful to see whether you've got different reactions to this. Plainly, the Commonwealth and the banks have an interest in the viability of the providers to which you lend money. And the ones that you don't lend money to are likely to be the ones that are less likely to be viable. But where you do have viability, we have an interest, common interest, as I say we, the Commonwealth and the banks, the financiers, have a common interest in viability, and obviously the financiers' interest is also a self-interest. I don't say that negatively, it's just that you want to make sure that they are viable because you need to make profit out of them, and that's the way the world works. I wonder whether you've got any thoughts about what would be a good way of dealing with that common purpose in a structural way that deals with things like banks reporting to the regulator when banks feel that the regulator can assist, bearing in mind that the role of the regulator is not there to make the bank's profits work, but to assist in the provision of aged care. Is that something that any of you want to tread into?
I'll make an attempt. I'll make an attempt to answer, Commissioner. Look, so I think my immediate thought there would be one of privacy around the individual operators' activities vis-a-vis sharing that with a regulator. I think there's some merit to it. I think the manner in which your question was there was, whether the banks could be involved in alerting the regulator to performance outcomes or adverse performance outcomes, perhaps. I think that's a possibility, but I think it's probably more one that I think with as I said earlier, a well-functioning regulator with a regular flow of information should be able to capture some of those changes in the performance of an operator.
I suppose I might put the point slightly differently. You're quite right, Mr. Williams, that one possibility is should there be reporting that way, the way you've indicated. But another way of looking at it is that the viability of the people that you want to be viable will be most effective or more effective if the regulator is doing its job of ensuring viability as well. So looking at it from your point of view, what would you like to see the regulator doing that will both ensure better viability from our point of view as well as being helpful to viability from your point of view?
I think it would go to the long-term sustainable operating cash flow of operators. Certainty of outlook insofar as the pricing and funding structure is very important, and that will be a key feature to allowing operators to continue to invest. So certainty of outlook and regulatory regime. I think specificity around liquidity, as all the banks noted, we provide very clear requirements around financial indicator covenants and also ongoing reporting. I think they are all conducive to ensuring both high quality care to meet the community standards, but also an efficient operation. Operators are in the industry. So I think it's those elements, but I think it's absolutely around underpinning the long-term sustainability of cash flow from operators to meet all of their costs, including their return on capital.
Thank you. Anyone else want to comment on the opportunity that you might have to make things better for everybody?
Commissioner, I would. There's very little to add to that. I think that stability and certainty is of critical importance, and in particular, reversing that margin erosion that we've seen in the industry over the last few years would absolutely help us as lenders be more effectively support the industry.
Councillor, I would also just add to that is that, from NAB's perspective, it's we want this to be a sector and continue to support the sector for operators that are of all different shapes and sizes. And in the current environment, it's becoming more and more evident that it's very, very difficult for the smaller operators to survive. And we see, with our client base in particular, family-owned businesses that have been in this sector for a long time and for the right reasons of delivering good quality of care, and they're passionate about it. So I would suggest that any future reform would look to address that balance where those providers and those operators can survive, run a really good business for their communities, and deliver an outstanding quality of care that they strive to do so.
I very much agree with what all the other panel banks have said. And really key for us is certainty of funding and certainty of funding structure going forward. And I think from both a bank's and provider's point of view, that will give us a clear path forward.
Thank you. Thank you to each of you. I'm pleased to formally excuse you from further attendance, and we're very grateful for the work you've put into the background material and to be available today to answer all these questions, some of which have been questions more or less not on notice, and we really are grateful to the way you've assisted our thinking on these topics. So thank you very much.
Thank you.
Thank you, Commissioner.
Thank you, Commissioner.
Thank you, Council.
We're due for 11:15 restart, Commissioner.
All right, we'll adjourn until 11:15.
The Royal Commission is adjourned until 11:15 a.m. The Royal Commission is now in session.
Great.
Thank you, Commissioner. I call Dr. Linda Mellors, Mr. Ian Thorley, and Mr. Nicholas Merciades. And perhaps before we affirm or swear the witnesses, we can take appearances, Commissioner.
Oh, yes. Ms. Newbold.
Beverly Newbold, legal to appear from Minter Ellison for Estia Health.
Yes, thank you, Ms. Newbold.
Dr. Mellors, do you solemnly and sincerely declare and affirm that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. Thorley, do you solemnly and sincerely declare and affirm that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. Merciades, do you swear by Almighty God that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. Merciades, you are the Director of Aged Care of Catholic Health Australia, and you've prepared a statement for the Royal Commission, another statement I should say, in that capacity. Can I ask that that be displayed so that you can see it? It's RCD 999903190001. Is that a copy of your statement of the 11th of April 2020 in relation to funding and finance matters?
Yes, it is, Council.
To the best of your knowledge and belief, are the contents of the statement true and correct, and the opinions in it opinions which you sincerely hold?
Yes.
All right, Commissioner, I tender the statement.
Yes, that statement will be exhibit 21-18.
Thank you. Just before we go to the other two witnesses, I'll just ask Mr. Merciades that you confirm a few brief introductory matters. You're also, in addition to being Director of Aged Care of Catholic Health Australia, the acting chair of the Aged Care Financing Authority at the moment. Is that right?
That's correct. Just holding the fort for the moment.
Yes. You're not making a statement, and you're not giving your evidence today in your capacity as acting chair of ACFA, though. Is that correct?
Correct.
And Catholic Health Australia, as you've said in your statement, is in effect an umbrella organisation or a member-based organisation. Is that right?
That's right.
And it undertakes advocacy and policy development on behalf of its members. Are all its members associated with Catholic Church entities that provide health and aged care services?
Yes, when in one way or another they would be, yes.
Yeah. And in that sense, this grouping is Australia's largest non-government grouping of health and aged care providers.
Yes, I believe so.
Yes, delivering care in accordance with the Church's mission. Is that right?
Correct.
Thank you. Now, can I go next to Dr. Mellors? Dr. Mellors, perhaps I should be calling you Professor Mellors, I'm not sure.
No, Dr. Mellors. I finished that position.
Okay, fine. Dr. Mellors, you're the CEO and Managing Director of Regis Healthcare Limited, and it's in that capacity that you've prepared a witness statement for the Royal Commission on Funding and Finance Matters. I'll just ask that it be displayed for you. And am I correct in describing your role and the capacity in which you've prepared the statement?
Yes, thank you.
Thank you. The statement is RCD 999903770001. Can you see that displayed before you?
I can, thank you.
And is that a true copy of your, or at least of the first page of your statement of the 14th of July 2020?
Yes, it is.
And to the best of your knowledge and belief, are the facts referred to in the statement true and correct? And are the opinions in the statement opinions which you sincerely hold?
Yes.
Thank you. I tender the statement.
That's Exhibit 21-19.
Thank you. And again, before going to Mr. Thorley, I'll just ask you a few things about your experience and your organisation, Dr. Mellors. You've held the role of CEO and Managing Director since September 2019, and before that you've had a lot of experience in roles with a not-for-profit provider and with various aged care and community services. Is that right?
That's correct, and also with acute hospital and community services.
Thank you. And have you been in government positions as well? Is that right?
So I've been in health services that are government owned and controlled. I did spend a very brief time in government in a palliative care role.
Thank you. And you've had executive roles in the Victorian public health sector for that for more than 15 years.
Yes.
Is that right?
That's correct.
Now, I'm not saying that you've prepared your statement in this capacity, but you are also currently chair of the Aged Care Guild, the representative organisation for some of the larger providers. Is that right?
Yes. Yes, that's right.
Thank you. And what about Regis? It's a publicly listed parent company. Is it of 3 approved providers?
Yes.
And through those approved providers, Regis has over 7,000 operational places. Are they the residential places?
That's correct.
And in addition to that, Regis provides home care services through 6 home care hubs.
Yes.
Also, Regis operates 540 retirement village units across 8 villages. Is that right?
Correct.
Thank you. Mr. Thorley, I'll turn to you now. Mr. Thorley, are you the CEO and Managing Director of Estia Health Limited?
Sorry, Mr. Gray.
Yes, and in that capacity, Mr. Thorley, have you prepared a witness statement for the Royal Commission? I'll ask that it be displayed. And I'm not able to read the code, but are you able to confirm that what you see on the screen in front of you, which I'm not able to see, is a true copy of your statement?
That's a true copy of my statement.
I think I can now see it. Thank you, operator. I'll just read it into the record. WIT stop 0776 stop 0001 stop 0001. To the best of your knowledge and belief, are the facts referred to in the statement true and correct, and the opinions in it opinions you sincerely hold?
That is correct.
Thank you. I tender the statement.
That's Exhibit 21-20.
And Mr. Thorley, I'll just ask you a few brief questions by way of introduction. Your professional experience includes health and aged care in Australia and in international contexts, including public and not-for-profit and for-profit entities. Is that right?
That's right, Mr. Gray.
And your previous roles include Chief Operating Officer of Estia Health and Chief Operating Officer of Opal Aged Care.
Correct.
And although you're not making your statement or giving your evidence in this capacity, you're also a director of the Aged Care Workforce Industry Council Limited. Is that right?
That is correct.
As for Estia Health is the owner of Estia Investments Proprietary Limited, which is the sole approved provider in the Estia Group. Is that right?
That's correct.
And it operates 69 residential aged care facilities representing 6,046 beds. If that's changed since the statement, we can just say approximately that number.
Approximately.
Is that right?
That's correct.
Thank you. And Estia also is one of the listed residential aged care companies in Australia, listed on the ASX. That's right, isn't it?
That's correct, yes.
Thank you. And members of the panel, I'll be posing questions to you on a series of topics, broadly following a document that I hope has been provided to you. And after a brief response from a panellist whom I'll nominate each time I pose a question, I'll then invite responses from the other panellists by way of addition to or comment on what's been said by the first panellist. Can we start with the adequacy or inadequacy of funding for residential aged care operating expenses? And I'm deliberately referring to operating costs because capital costs are in effect a separate topic that we'll come to in part later. It's uncontroversial on the evidence the Royal Commissioners have heard during this hearing that funding levels for the provision of residential aged care are not currently adequate. That's been acknowledged in evidence by, for example, witnesses of the Department of Health, and it's an inevitable implication of reports that have been made by ACFA and others for some time. My question, over recent years, have funding shortfalls in the residential care sector, or the segment, had an impact on staffing levels? Have funding shortfalls had an impact on staffing levels in residential aged care? Ms Mellows, or Dr Mellows, I should say. I'll start with you.
Thank you, Council. So I think the things that we can see in the data is that staffing costs have increased as a proportion of total costs, but operators have taken measures to reduce staffing costs as a result of the inadequate funding. So I think that there are implications there in terms of quality and staffing. So I think in terms of the ways that we've seen operators reduce staffing costs, there are a number of matters there. One is the overall numbers of staff who would be on the floor in a residential aged care home. The second is replacing staffing types with a lower cost staffing type. For example, you can see that there are operators who have replaced enrolled nurses with personal care assistants. We can also see that staffing turnover is high, which is a problem. And we've also seen staff exit the sector where other sectors can offer a better salary for equivalent skills. So for Regis, I can tell you that we've been able to put things in place because of our size and scale to mitigate the risks of some of those staffing changes, like an internal nurse on call program, but that opportunity wouldn't be available to smaller providers.
Thank you. Mr Merciades, do you wish to add anything or comment generally?
I would just point out the Stuart Brown survey results, which, while acknowledging what Dr Mellows has said, which is correct, it's also that those surveys are showing that in recent years there's actually been a marginal increase in staff hours per resident. Not much, and to the extent that there have been additional costs, it's been reflected more in reductions in margins rather than reductions in staffing costs. That's what the Stuart Brown evidence is suggesting.
Thank you. Is there any attempt to correlate that to increases in acuity, Mr Merciades, to the best of your knowledge?
Putting the pandemic issue aside, I do not have evidence to suggest that there has been, in the last couple of years, a significant decrease in safety and quality. But I also point out that some of the data would suggest that it may be the case, but I'm also aware that the Quality Commission, since the Oakden issue, has significantly stepped up its regulatory functions, which could account for the fact that there's a bit more data which suggests that there has been a bit of a decline.
All right, thank you. Mr. Thorley, would you like to add anything?
Yes, I'd make the point that it's not been SD's experience to reduce staff. In fact, we've increased staffing over the last number of years and done that to counter a number of things, to reflect the increased security that we see coming into our organisation, but also at a corporate level, we've added quality and training resources to reflect the changes that have been brought about by the establishment of the Aged Care Quality and Safety Commission. And I agree with what Mr. Merciades said with respect to the Stewart and Brown data. It certainly indicates that year on year, both in the average group, as they describe it, and also in the top quartile group, there has been an increase in work hours per resident day. So that's a large sample. I cannot comment on the rest of the industry.
Can you explain, Mr. Thorley, the connection you're making between increases in staffing levels and training? Is that a function of having to cover shifts to enable people to attend training?
No, it's really about quality training, central office resources to bolster the skills of our home-based employees.
Okay, thank you. I want to ask about what might be the sustainability of that trend if there's no change in the method for establishing funding levels and the general trajectory of those funding levels, and what might be the solution to that. Start with you, Mr. Thorley. Is it sustainable, given what you've said about SD's experience of, in fact, increasing staff, and you're pointing out that that's in line with data coming from Stewart Brown? And if it's not sustainable, what's to be done?
Well, I think the information that comes from Stewart and Brown, and also as reported by ATVA, certainly speaks of the margin compression and the challenges that will bring to the sector. And indeed, in our FY20 financial reporting, we saw a significant reduction in both EBITDA and profit after tax of our operations. So there is this sector-wide tendency and trend that is seeing a serious decline in the sustainability of a large amount of the sector. So I think, we look forward to some form of funding and financing reforms that will address that decline.
All right. Are you able to, or do you wish to elaborate further on what form those reforms should take in SD's view?
Well, I think there's an urgent issue, and it's a pressing issue, and that is to ensure that there's adequate funding to provide the level of high quality and safe care that the community expects of residential aged care. And I see that being incorporated in a number of the propositions that we may be talking about today, and particularly the establishment of the independent pricing authority. I think more broadly, though, there are a range of reforms that need to be undertaken that look to broader sector sustainability. I don't for one moment think that more government funding is going to provide a resilient and robust residential aged care sector going forward. A number of the propositions that are included in today's discussions regarding prudential reforms, the capacity of people who've got the means to contribute to their care, an appropriate safety net, I think they're all important. But Outside of those, I think the most important sector reform that we need to urgently see enacted is the recommendations of Professor Woods regarding the creating of a more competitive market and providing fund holding to the consumer. And that will ensure that there will be investment in the sector. It will provide greater consumer choice. And with that, I believe one would see improvements in the quality of services and indeed the range of services that are being provided.
And Mr. Thorley, are you referring specifically to Professor Wood's recently published report, jointly authored with Mr. Grant Corduroy, in relation to the introduction of more competition in the residential aged care segment or sector by reform of the ACAR process and the uncapping of residential care subsidies?
That's the report that I referred to, and of course, that is also contingent upon there being an appropriate safety net, but also an improved reporting regime where the consumers have got far greater information on matters of pricing costs and moreover output indicators, be it compliance, customer satisfaction or clinical indicators, to ensure that in that open and more competitive market they can make informed choice.
And if I asked you what's Estia's most pressing reform issue of all, is it one of the ones you've mentioned?
I think it's probably the most pressing issue is the need to ensure that there's adequate funding to ensure that the current trends that are being described by Stewart and Brown and ACFA are addressed. That's an immediate reform, but all of the others need to follow closely. In fact, they're an integrated bundle. I don't think they can be picked apart, and I think that's been a view expressed by informed commentators over a number of years.
Thank you, Mr. Thorley. Mr. Merciades, I'll go to you next, and in essence ask you the same questions and elicit the response of Catholic Health Australia. Firstly, is it sustainable, assuming it isn't, that is that squeeze I think Mr. Thorley referred to, between the trend in having to lay on additional staff, presumably driven at least in part by acuity, but perhaps other factors such as training and an increased regulatory focus on the one hand, and the funding trajectory on the other. And if it isn't, what are the solutions? And then I'll come to ask you about pressing reform issues in Catholic Health Australia's view.
Thank you. In my view, the current funding system is not sustainable. Providers, organisations can make a loss for a year, maybe 2 years, but a succession of losses is just out of the question, which is the scenario that many providers are currently facing. And that's because the current funding system is just not fit for purpose. It is the funding that's being provided is not keeping up with costs. Essentially, it's predicated on an indexation formula, which is based on a labour productivity expectation, which is not sustainable. As you've heard evidence before, it involves a significant discount on the minimum wage adjustments. And in the past, providers have been able to manage that, what I call a punitive indexation arrangement, through their claiming arrangements under the ACFI, where over the life of the ACFI, the real increase has been something like 5% per annum. Whereas under the current arrangements with ACFI, which were introduced in 2016-17, that real increase is as low as 0.5%. So you can see with punitive indexation, a low real increase, that there's no chance that the current system is going to be able to match cost increases, and also increases in consumer expectations, older people's expectations about the quality of care that they receive. Now, while recognising that there's a large number of reforms which would be a dead heat for coming second. I would prioritise the creation of a reform independent pricing authority to administer a new funding system as a means to increasing the number of staff, paying them better, and upskilling them more, and which will be required if we're going to be able to meet community expectations about quality of care. But that has to be in the context of a system where older people have much greater choice of the services they receive and who provides them.
Thank you very much. Dr. Mellors, the same questions intended to elicit Regis's response, so starting with the sustainability issue, and then going to the solution to that, and then what's Regis's most pressing issue of all.
Thank you, Council. So I support the comments made by the other panellists. So the funding situation, it's not sustainable, and the staffing situation is not sustainable. So I think what we've seen in the evidence that's come before the Royal Commission is that the staffing and the funding are inadequate to deliver the current level of quality of care to older people in Australia, let alone the kind of care that we would all like to provide. So I think that's a really important starting point. I would agree that this needs to be seen in a very integrated way and as a system rather than pieces in isolation. So what I would say from Regis's perspective, what we would like to see is that firstly, aged care quality is properly defined, because I can't find a definition of what quality looks like in aged care. And I think we should be able to come up with that so that everybody knows what it is that we are aspiring to. Then there needs to be proper costing done of the staffing models that would deliver that level of quality. And at that point, we would actually be able to cost it and know what the funding ought to be to deliver the high quality care. So I think I'll bring it back to first principles that we don't have that definition in place, and that is something that's desperately required in this sector. I would also support the comments around an independent pricing authority. Coming from the acute sector, we had the Independent Hospitals Pricing Authority. There was a lot of data that was analysed as part of the costing analysis to be able to come up with what is a national efficient price. And that was able to take into account changes in models of care, changes in staffing structures. So if there were efficiencies derived, for example, then that would be picked up through the cost weights. But if there was a change to the model of care, you could also advance fund particular changes to a model to get to a predetermined outcome, if you like. So from Regis's perspective, I would like to see the definition of high quality care that is then backed up by a workforce model that is properly costed along with the indirect costs by an independent pricing authority.
Thank you very much. Now, already from the answers you've all provided, it's evident that the propositions that are currently before the Royal Commissioners for the purposes of this hearing, and which we've asked you to consider in advance of this hearing, don't cover everything that needs to be covered. And for example, Dr. Mellors, you've raised the importance of having a proper definition of what is high quality care so that that can inform staffing models, and those will be, as I take it from your answer, they will be very important inputs into what you join in supporting in the form of independent pricing, which is covered by the propositions. And Mr. Thorley, you've also raised contextual matters relating to the uncapping of the per capita planning ratios that apply to residential care places and the way they're allocated, and these are not covered here, although aspects of those were covered in our earlier submissions in March, where the council assisting team submitted to the Royal Commissioners that the system should move to an uncapped and demand-driven system. Those qualifications noted, can we now go to the propositions and tease out your responses to the detail which is recorded in the propositions before us, starting with the Aged Care Pricing Authority proposition FF1. Mr. Thorley, I'll go to you first. Outside the contextual points you've raised about the need to address the uncapping of the supply of subsidies, the per capita planning regime that applies to the release of subsidies, what are your thoughts on the detail of the proposition? Are you supportive of the proposition? Do you have difficulties with its workability? What are your thoughts?
I think the establishment of an independent pricing authority is absolutely critical to ensure that, some of the things that have been described by various groups and presented to the Royal Commission during its hearings are avoided into the future. I think an independent pricing authority would be well equipped to undertake the studies required to develop a efficient price or subsidy that would be provided by government for the support of the residential aged care system. I agree with Dr. Mellors in that one of the critical things that must occur is an expression of what is quality. It needs to be defined because to date there has been no real description as to what's being funded in respect of that particular issue. So I certainly support wholeheartedly, and as I say, absolutely fundamental to ensuring that there is an independent review and independent determination of what's required to sustain this.
Dr. Mellors?
Thank you, Council. So I'm in very strong support of this proposition. So I've seen an independent pricing authority work very well over an extended period of time in the acute sector. And I think that this would be an enormous advance for the aged care sector to have this kind of modelling in place. It would also provide us from a system level much better information around the links between quality of care and funding. And would also provide us with appropriate benchmarks. So very strong support.
Mr. Merciades?
Catholic Health Australia also strongly supports this recommendation, but we would note though that there would need to be some adaptation in terms of methodology that's applied in the aged care sector compared with the hospital sector. In aged care, you're looking at long-term care, you're looking at quality of life, and you're looking at personal private contributions as well. So that sort of just complicates the mix a bit, but it's eminently doable, so subject to those modifications around methodology. And quality is also measured in a different way in an aged care context compared with the efficacy of a medical procedure.
Mr. Merciades, I'll stay with you. Let's break this down further, and I might ask you to explain in a little more detail how some of those issues you just raised might play out. That is, the necessary adaptations that would be required if one was to move the hospital's services pricing model into aged care. The current funding arrangements for residential aged care treat three sets of services and their associated revenues separately, don't they? They are living expenses, the basic daily fee, accommodation, and here there are in effect, three possibilities in play. The accommodation supplement, that's the government subsidy for supported residents. And then there's for unsupported residents, refundable accommodation deposits and daily accommodation payments, or a combination of the two. And then to add complexity, there are people who are partially supported. Now, the third category is care, and currently it's the aged care funding instrument, ACFI, Basic Care Subsidy, that is both the price and subsidy level setting instrument and the source of revenue for care. In addition, there's the possibility of extra services and additional services. We can come to that later. I think in the main, let's just confine the discussion to care as care funding as determined under ACFI. Mr. Merciades, should that broad structure continue? And what are the reasons why not?
I think it should. It provides the basis for determining policies regarding the balance of private and public contributions towards people's residential care. Picking up the fact that living expenses is something you normally expect to be funded privately, and similarly for accommodation, but within that, subject to safety nets. In the same way as the age pension is a safety net when it comes to living expenses. And also when it comes to care, it recognises that we do have the Medicare principles operating in Australia, where the expectation is that there would be a significant pickup of costs by the government and the community. So the fundamental point is it's a structure which allows a rational approach to determining the balance of private and public contributions, but recognising, however, that revenue in the hand of each service provider, excluding the permitted uses for RADs, can be used flexibly to achieve the outcomes of better aged care.
All right. I'll just stay with you, Mr. Merciades, before going to the other panellists. On the basis of that answer, and assuming that broad structure continues, to what extent does the independent pricing body, which all three panellists support in principle, have a role in determining A, the subsidy levels in respect of each, to the extent that there are subsidies, and B, any price caps, that is setting the prices for the actual transactions which place revenue into the hands of the providers in return for providing the relevant services. Your thoughts, Mr. Merciades?
I think the Independent Pricing Authority would have a hand in all three of those, and this is part of the methodological challenge that they would face, but I'm sure it can be managed. And when it comes to the accommodation, it would be around the accommodation supplement for those with lesser means, where they would have a role. And so it can be done, and I think it should. The responsibility should go across all three components.
Thank you, Dr. Mellors. Do you want me to repeat those questions? Starting with the structure, let's start with the broad structure. And depending on Regis's position on the broad structure, I'll then go to the more detailed questions.
Certainly, thank you, Council. So I would support the comments just made around keeping those three components separate and being able to effectively cost them separately. So Mr. Merciades is correct that there are some differences, of course, to the hospital sector in terms of the kinds of expenses that are incurred when providing residential aged care. So I would keep them separate. I believe that they can be costed effectively by an independent pricing authority, particularly obviously the care and living expenses. I think consolidating the technical expertise in the one independent pricing authority makes sense from an efficiency perspective, and I think oversight of accommodation would be an excellent idea to place in with the pricing authority also.
Thank you. And I think you've covered everything. I'm going to come back to accommodation in a little more detail later. But I'll first go to Mr. Thorley and ask about Estia's position, firstly on the broad structure and whether that broad division into those three categories of services and revenues should be maintained, and whether there's utility in separately costing them, and if there is, to what extent should the regulator play a role, Mr. Thorley?
The way Estia conducts its business, it clearly doesn't separate revenues and matching costs. We see those three areas coming together in a complementary way, a complementary set of services to provide the quality of care to our residents. But in terms of a pricing authority needing to undertake studies to determine an efficient price and subsidy levels, we would support this construct as a way of doing that.
Okay, thank you. And I'll go to accommodation in more detail, as I said, but are you able to give the Royal Commissioners an indication of Estia's view on the scope of the price or subsidy level regulation that would apply, say, to living expenses and care? And we might come to accommodation in more detail later.
Well, I think with regard to living expenses, it's been identified again by Stuart Brown that there is an inadequacy in the current level of the basic daily fee on the basis of their somewhat, extensive cohort that subscribe to that data set. And it would be our view that that needs to be attended to, and that would be the price that would be billed to, or the price paid by non-supported care recipients. With regard to supported residents, currently there is a 85% of the basic pension contribution to daily living, and any gap between that 85% and the price that is determined, I would see should be supported by government. I would also, yeah. No,
I'm sorry, please. Okay, I'll just show FF18 on page 11 of our propositions at tab 111, and we'll get your immediate reaction to FF18 as amended. And I think it's on all fours with what you just said, Mr. Thorley. Are you, from Estia's point of view, content with FF18, and are there any changes or additions you'd make?
No, that supports what I've said.
Yep. And Mr. Thorley, I think I might have interrupted you. Were you going to add something on the scope of the regulatory role, either price setting or subsidy level setting, in the context of care?
I do see there in some of the propositions there's some suggestion that the pricing authority might have some involvement in the setting of fees that are currently not now necessarily set by an authority, and for example, additional services and things like that I don't necessarily see the pricing authority having an involvement in activities that can be negotiated and agreed between consumers and providers. And I think in regard to the basic daily fee, there's been propositions put forward in the past regarding the ability for consumers to contribute more to the basic fee to enjoy a range of services that they can't currently enjoy. And I think that again should be an important consideration in the development of the pricing for those particular services.
Thanks, Mr. Thorley. Before we go on to a different topic, I think it's important to go back to you, Dr. Mellors, and then you, Mr. Merciades, to raise two things which Mr. Thorley's just mentioned. Firstly, additional services, and secondly, some scope for more than the price-determined amount for ordinary costs of living contemplated in FF18 to be charged on a negotiated basis between residential care providers and their residents, and those two things are linked. Dr. Mellors, what are Regis's views on these matters? And in addressing the point, if there's a need for clarification of the scope of additional services, please do express any views of Regis to the Royal Commissioners on that point.
Thank you, Council. So I would start by saying that additional services are very popular amongst residents and their families, which tells us something about the service offering in aged care. In terms of the regulation around additional services and the basic daily fee, so I take Mr. Thorley's comments, and I've seen the same literature around the possibility of combining additional services and a basic daily fee, and having providers able to negotiate directly with residents the one charge rather than having the two separate charges. I do think it's important that there would be a minimum level set for the living expenses, otherwise the sector could find itself in a difficult position again. And I think that there will always be a need for consumer protections in terms of price gouging, etc. But I also note that there are regulators currently in place that deal with consumer protections, and we should make the most of the existing infrastructure that's in place. So for Regis, we would want to be able to continue to offer additional services and to be able to alter those additional services according to the expectations and the preferences of consumers. I would also like to make the point that we know that different generations of older people will have different preferences around additional services. So again, flexibility in being able to change and adapt those additional services to the needs of particular populations is a very important part of the policy settings.
Thank you. How would the minimum content of what is being paid for by the regulated price for ordinary costs of living be determined in practice? Is that essentially already an issue in the industry, and it's a matter of just careful transparency as to what is being provided in return for the basic daily fee?
So there are a couple of issues there, Council, that I would like to cover. So I think it's important that there are minimum standards set for what is provided as part of the living charge. And providers should aim to at least meet the minimum standards and be able to offer better if they can, and that's what their residents desire. So that would be a fundamental principle for me. The second issue is around the specified care and services and how the the Act and the principles associated with the Act are interpreted at different times, and we have seen different interpretations of what's included in the specified care and services and what falls into an additional services paradigm. So some clearer articulation there would be helpful, along with the changing expectations of what should be standard now compared to when the specified care and services were first written. And I think that there are a number of elements that people would expect as a standard now that were considered to be an optional extra when some of these documents were written. So I would suggest that there be a review, and again that the living expenses charge or price is calibrated against a contemporary expectation of living standards.
Thank you, Dr. Mellors. And just for the record, I think you're referring to Schedule 1 of the Quality of Care Principles 2014 when you refer to the specified services, specified care and services. Thank you. Mr. Merciades, what are your thoughts on the points that have been raised by Mr. Thorley concerning some sort of more negotiable ability to determine the content of ordinary living services, if I can put it that way, and therefore what ordinary costs might be, and how would the mechanics of that best be determined, and how would that relate to the topics of setting the basic daily fee on the one hand, or additional services on the other?
Well, I would see a role for the Independent Pricing Authority to be setting the basic daily fee. That would be the price that a provider would receive, whether it's from a supported resident or a non-supported resident. But I would have a concern if, in principle, if that involved a capping of the fee that could be paid for living expenses and lifestyle issues, because I think older people should have the capacity to be able to exercise some choice as to the standard of living that they want in their older age. But the issue, though, is the one that Dr. Mellors referred to, is drawing a distinction between what would normally be expected to be provided from within the capped fee that applies to everybody and what is additional. And I think a lot more work needs to be done around getting regulatory clarity around how that would operate, and more importantly, regulatory clarity around protections for older people as well. For example, on issues to do with whether prices can change during one stay in the aged care home, or whether fees should continue to be charged where someone can no longer benefit from those additional services. So I'd be looking to the Tune report recommendation, which talked about a basic level which would apply to everybody, and then a capacity for providers within a regulatory framework to negotiate additional services for a fee. Probably I would still have a cap on that in the way that David Tune recommended as well, just as an additional protection for consumers.
Okay, thank you, Mr. Merciades. I'll stay with you and I'll ask you about proposition FF2. Should the setting of funding levels for living and care, and we'll come to accommodation in more detail in a minute, but should the setting of funding levels for living and care take into account indirect costs? Should it also take into account some form of profit margin? Should those matters be factored in by the Independent Pricing Authority? Mr. Merciades?
Yes, I believe so, and that would be consistent with your principle 0.7 in your financing paper, where you highlighted the importance of a system having incentives in there for people to improve the quality of care and at the same time also achieve efficiencies, and that a major driver of that would be a capacity for services to achieve a rate of return, within a pricing framework that the Independent Pricing Authority operates.
And Mr. Thorley?
Mr. Gray, I certainly agree that there should be the opportunity for the providers of residential care to get appropriate returns on their investment. And I think we need to recognise that of the 2,700 residential aged care facilities in Australia, 2,500 of them are provided by the non-government sector, be they ASX listed like the two here on the panel today, or whether there's private investment, or for that matter, whether they are from the charitable for purpose sector. All of those organisations contribute private capital, and there needs to be an appropriate return for that investment to continue.
We'll come to accommodation and the very capital-intensive nature of that in a moment, but I take it that your remarks are general in their application, Mr. Thorley.
General in the application, but when we think about the services provided, there needs to be a return on those services as well.
Yes, and Dr. Mellors?
Thank you, Council. So I'll probably offer a slightly different perspective. So to start with indirect costs, yes, they absolutely do need to be funded. Indirect costs are just as critical as the direct costs in terms of what they fund. So I think about things like clinical governance, quality and safety, work health and safety, technology, etc. All of those things contribute to the quality of care and experience of residents and also of our employees. So I would just really want to make a very strong point around the funding of indirect services. In terms of the profit, so somebody who's worked across private, not-for-profit and government, I've had similar targets wherever I've been in terms of making either a profit or a surplus. People use different words, but everybody needs to make a return. Whether you would put in a margin for that return in the funding or not is something where I suspect if we had a national efficient price for these things, then you would have operators who would be able to return a profit or a surplus based on a national efficient price. And I think it's also important that we understand what a profit or a surplus is used for, and that we do need it for ongoing innovation and to provide returns, as Mr. Thorley was saying. But it's also used to pay down debt. There are a whole range of things that profit or that surplus is used for. But I'm not sure that we need to have a specific profit margin funded in.
Okay, thank you. Can I stay with you, Dr. Mellors, and go to propositions that relate to the specific mechanism on which or via which residential care funding for care might be provided in the future? And we'll start with FF7, which is a proposition that aged care services be funded through case mix adjusted activity based funding arrangements, and our thinking here is this is predominantly well adapted to residential care funding. We just seem to be getting a little bit of feedback. I wonder if it's me. Might have been me. This is predominantly well adapted to residential care funding, but there's a prospect of elements of case mix funding being available in the home care context too, perhaps, but we'll stick with the residential care segment at the moment. Now, as you'll see in the narrative under FF7, we are acutely conscious of the ANAC and the Resource Utilisation and Classification Study. So one would, of course, have to give very, very close consideration to that as the particular case mix funding model on which estimation by an independent pricing authority of a national efficient price would be based. And in effect, FF9 and FF10 are incidental to, or they form part of the same suite of recommendations, with FF10 being an interim measure for additional funding tied to increases in staffing levels in the interim while the new case mix adjusted activity-based funding model is established. FF9 is to continue certain specific supplements for which there isn't specific provision in ANAC as currently drafted, although there are certain other loadings for remoteness and so forth. We don't see those particular supplements in there. So Dr. Mellors, this suite of propositions, what are the thoughts of Regis on these three propositions, FF7, 9 and 10? Do you have improvements to make?
Thank you, Council. So I would start by saying we're in support of the propositions. They're good propositions and they would be effective in the aged care setting. The improvements that I would like to suggest relate particularly to proposition FF10, which is around the link to an increase in staffing levels. So what we know is that there are a range of staffing levels across the sector. And Mr. Thorley used a metric that I also prefer, which is worked hours per resident day. That's a very useful way of determining how much care is being delivered to a group of residents. We need to be particularly mindful, I think, around different residents having different needs and also different preferences. So I would like to see absolutely an increase in staffing levels. I believe that's agreed across the board. It's the model by which you might implement that. So for some large providers, we have extensive support structures. So if I speak to Regis in particular, we have central quality and compliance teams, clinical support teams, our own nurse on call team that's there to support every home around the country during the after hours period. We have centralised work health and safety, as well as all of the other kinds of support structures that you would expect. So I would just like to see that there is some flexibility in terms of where the staffing is applied, because you obviously get different benefits from different levels of staffing and different levels of expertise. So I'm in support, but I just would like some flexibility within that particular proposition.
Thank you. Mr. Thorley.
I think the three propositions are sound. I do certainly support Dr. Mellors and the comments made about episodic or case mix arrangements. I do think there are some differences between hospitals and residential aged care, and that's that quality of life element. And I think it's very important that that is considered in the construction of the AN-ACC. And that is about the fact that, unlike the hospital system that is relatively transactional, short stay and fairly predictable outcomes, that is very, very different to the sort of whole of life long-term services that we provide. The whole of life experience, I should say. In terms of supplements, agree with that as described in FF9. In terms of the staffing element of this, I agree with Dr. Mellors as well that this needs to be somewhat nuanced. as I indicated earlier, it's been SDU's experience to provide additional staff to our homes, as well as our central services, to reflect changes in the operating environment that we've encountered over the last couple of years. And I'm somewhat taken to the idea that the best way in which staffing increase should occur is to look at the resident need and assess what skills are required to support that need, and then the metrification or the numbers should come after that. And I think there needs to be absolute recognition that appropriate levels of staffing are absolutely essential for high quality and safe care of our residents. But I think we need to be careful of looking at inputs, that is additional staff, and assuming that that will potentially automatically guarantee increased care. And I don't think that that is the case. And I think any consideration of these additional inputs also needs to consider what the outputs might be. And that goes to the output measures that I spoke about earlier, be it compliance record, be it the customer experience, maybe as recorded by the quality agency's own CER reports, but moreover things like clinical indicators and satisfaction measures that can accurately describe the outputs of care.
One of the great challenges with these arrangements is that we've seen quite a crossover in the level of qualified staff in residential aged care, with the proportions of both enrolled nurses and registered nurses falling, while the proportion of personal care and other workers has been increasing. And this is at the very time when we've seen a significant increase in acuity. So it's very hard, Mr. Thorley and Ms. Mealaws, or Dr. Mealaws, to look at this in a way that doesn't require something in the level of input controls to protect the interest of the people who are now living in residential aged care. I put that to you.
I think if I can respond to that, Commissioner, I think it's an important observation, and I should probably qualify what I said to suggest that there needs to be a real focus on the outputs, and there certainly should be some input measures as well. And I think the thing that you particularly refer to relates to skill, and I think again I go back to my observations that we absolutely need to reflect upon resident needs, and in that I mean acuity and clinical complexity and all of those things that we know are occurring as a result of the home care settings where people are coming to residential aged care older and with more comorbidities. So the issue of skill is absolutely critical in achieving the outcomes that the community seeks, and indeed all of us who are involved in residential aged care seek to see provided for our residents.
And may I also respond, Commissioner? So thank you for those comments. I think I may not have articulated myself clearly enough at the beginning when I was talking about the funding pressures and the way that many operators have been effectively forced to replace lines of staffing with a cheaper cost alternative. And I think that goes to what you're speaking of, where the number of hours in terms of registered nurses and enrolled nurses has decreased while personal care hours have increased. So I think that observation is absolutely correct. And my consideration of proposition FF10 and my request for flexibility is that we look at the level, not just the hours, because different levels of staff provide different contributions. So for me, it's also tied into the pay rates and the level, not just the hours of staffing. So that was my request for flexibility. I do believe we need more hours on the floor as well. Because a very important component of quality of care is the time to care. And that goes to Mr. Thorley's point around a person's experience of care. And we know that when people feel rushed, that they might not raise some of their concerns with their aged care workers, and that can impact on their quality of care and quality of life. So my request is for flexibility in terms of hours, levels and pay rates.
Mr. Merciades, I want to give you an opportunity to comment on these three propositions.
Thank you, Council. Well, I think the three propositions are basically sound. On the staffing issue, I think it's quite reasonable for the Australian government, who will be picking up the lion's share of the cost, to be wanting to see some satisfaction as to how that additional funding is used. And we all acknowledge that that more staff, better paid staff and higher skilled staff is essential to achieving a higher quality of care. And so I'd also be very supportive of increased disclosure that would provide information about what providers are doing in response to the additional funding. But that information would also be useful for the Independent Pricing Authority as time goes on, in terms of providing setting its prices, but also setting prices at a level of quality which has to be gradually improved. But it's also useful information for the Quality Commission. It will be a significant indicator for her to consider when undertaking their regulatory functions. So I think the proposals are quite sensible, and through disclosure type arrangements that can incorporate a capacity for flexibility to take into account the different circumstances of the wide dispersion of types of aged care homes that operate in the country at the moment. And I've said it before to the Commission, there are some that operate on a care funding per resident of $40 or $50 a day, whereas others go all the way up to $20 a day. Staffing situation in each of those are going to be very, very different. Disclosure is the important consideration for me.
Thanks, Mr. Merciades. I'm just going to ask you about some points that I'm going to make by way of summing up where we've got to, and the points are all on these lines. If independent pricing is adopted, then it seems from what the panellists have all been saying that the process should be informed by certainly a review of costs, and we take that to be sector-wide costs. This is not an exercise in guaranteeing a particular provider that its costs will be met, but it's a sector-wide approach to understanding the costs of providing high-quality care. Now, on that point, we need to define high-quality care. There'll need to be indicators, and Mr. Thorley, you've mentioned this, Dr. Mellors, you've mentioned this. Presumably, there'll need to be performance outcome indicators that will feed into this process. And a lot of design work is no doubt needed on that question. I don't think we have time to try to unpack that here, but it's a big project in itself. There needs also, and I'll ask that a diagram now be displayed for you. This is something I put up on the screen during the opening. It's Exhibit 28.1, and it's also been commented on by a regulatory economist who suggested that it needed an additional function to be included. Can I just briefly explain it to you? There's providers providing services, providing reporting, we'll call it reporting to begin with. I'll come back to the issue of acquittal in a minute. That reporting is integral to the process of independent pricing along the lines Mr. Merciades just outlined, and that funding level and price setting function would include, this is what Professor Menezes told us, it would have to include efficiency benchmarking, and that would then lead to, in effect, an iterative process by which funding is provided at the relevant levels, informed by the determination of that independent funding level and price setting function. And the process goes on and is iteratively refined, I should say. There are other potential uses for that financial reporting along the lines of the list over to the right-hand side, involving the potential for incentives and financial performance monitoring, of course, and perhaps systemic monitoring as well. Mr. Merciades, you were referring to that information being important for quality and safety regulation. Financial reporting would be an important input into that as well. Now, in amongst that information and in the process of those iterative refinements, the matters concerning the need for staffing and skills mix improvement would be integral to the process of determining the funding levels. That's come from each of the panellists in one form or another. I want to ask, staying with you, Mr. Merciades, I want to ask you, I've summed up where we've got to, I've shown you the diagram. Is there anything that you take exception to in the summary I've provided? And is there any key addition that you'd make to the summary I've provided?
The diagram, the schema makes a lot of sense. There's no question there, that's fine. The difficulty that we're going to have is arriving, as Dr. Mellor said at the outset, of what is an acceptable standard of care and quality of life. And this particular diagram doesn't have regard to that. It's something that has to be front and centre, because at the end of the day, it's one thing to have an efficient price, but is it an efficient price of delivering what standard of care? I mean, if you were to establish an efficient price based on the current system, it would deliver the inadequate level of care which is currently being provided. So it's a question of how you move the system up to what is acceptable to the community. That's the difficult part.
Yes, thank you. Mr. Thorley, we're running up against a deadline with this session, and we've still got quite a few propositions to go through, but are you able to comment briefly on what Mr. Merciades has said?
I totally agree with Mr. Merciades' comments about an explicit characterising of what constitutes good care and what is the community expectation of that.
And Dr. Mellors?
Yes, I would agree with the other panellists, Council. I would just add, obviously, workforce availability, which I know you have considered separately. There is a global shortage of nurses, and we are also competing for workforce with the disability and acute sectors. So just how that will work from a broader system perspective, there will need to be more people trained to be able to fill these additional places.
Thank you, Dr. Mellors. That means I'll stay with you because I want to now go to that issue. ACFA presented a report in October 2019, Attributes for Sustainable Aged Care, Funding and Financing Aspects. It's incidentally at tab 46 of the tender bundle, but we don't need to go to it. Now, one of the attributes focused on achieving a skilled and motivated workforce, and ACFA's recommendations linked in with the aged care workforce task force recommendations. We, the Council assisting the Royal Commission, have made submissions in February about mandatory determination by providers of their staffing ratios and transparent reporting of those things. That's recommendation 1. Based on recommendation 2, some key minimum requirements for care time at different skill levels by reference to qualifications of staff. And I take it that all the panellists are familiar with those recommendations, so I don't think we need to spend too much time on them. They're really a premise for what follows. Assuming that recommendations of that kind were to be made by the Royal Commissioners, and assuming that this pressing need for additional staff arising both from those recommendations and from other factors is somehow to be met by the funding arrangements that the Royal Commissioners might recommend, how is the goal of attraction and retention of a skilled and motivated workforce to be achieved through these funding arrangements? In particular, in light of competition with the health and acute and disability sectors, how is labour condition parity to be achieved, or something like it to be achieved? Dr. Mellors, I'll start with you.
Thank you, Council. And if I could start by saying I prefer using a metric of worked hours per resident day than ratios. It's a more nuanced metric. And I would also just caution around the view of ratios. If you look at other sectors where ratios are in place, there are vastly different quality outcomes, even when you have the same ratios. So I certainly wouldn't like for the Commission to have the impression that ratios will address the quality issues. Staffing is one element of the quality of care. So in terms of the labour workforce and how we make aged care more attractive, so we know in aged care registered nurses are paid less than their counterparts in other sectors, and that is evidently a key risk for the aged care sector. It goes to the level of seniority in terms of the staff that we can attract. And we also see across the sector that many new Australian nurses will start in aged care and then move across to other better paying sectors. So for registered staff, pay parity, I think, is critical. And then for unregistered staff, we know that disability services pay, I think it's about $2 an hour more than aged care does. That's a very significant pay differential for personal care workers. And we did see a lot of people from aged care migrate across to the disability sector after the NDIS reforms were initiated. And my contention would be that elderly Australians deserve a well-qualified, trained and supported workforce in the same way that disabled Australians do. I also think that we could incentivise additional skills and qualifications in the way that the health sector does. For example, if a registered nurse undertakes a master level qualification, they're able to be paid a higher rate. And I think you could bring in some really effective training and development standards and qualification standards. At Regis, we employ personal care workers who are Certificate 3 and above, with very few exceptions that would be related to a training program. I think there's great capacity for graduate intake programs and having, really comprehensive and well-supported graduate nurse programs, for example. Aged care is a beautiful place to work once you are exposed to it, and it doesn't have the reputation that it deserves. And there is some really useful work going on in the sector around showcasing the kind of work that's done in aged care and the benefits of that work, both to the residents but also to the workers.
Thank you. Dr. Mellors, I might just ask the operator to display recommendations 1 and 2 from February, because I didn't do them justice when I gave a summary a minute ago. And if you look at recommendation 1, it's really, it probably has a number of working parts, but 2 of the working parts are that there is a requirement to have a minimum ratio, but it's not a fixed ratio. It's a ratio that's based on something very close to the metric that you prefer and that you refer to of the worked hours. I'm just interested in your reaction to the way in which that recommendation is constructed. Its mechanics seem to be based on a concept very close to worked hours in the different skill categories. And it's from there that a provider-specific ratio can be derived by that provider and must be established. Is that an appropriate approach in your view, and is it workable?
Thanks, Council. So I think it's a very good starting place. And I like the concept there. I'm particularly fond of a registered nurse being present on every shift 24/7. That's always been one of my requirements for aged care. The only concern that I have with that is as complexity changes and as the nature of what each segment of the workforce can provide changes, this might be too rigid in the future.
Yep.
But I think it's an excellent starting point for where the sector is now.
Well, thank you. And we need obviously to consider very carefully the intersection between these recommendations, the need for appropriate adaptations and flexibility, and the way those matters intersect with the role of the pricing authority, because of course this is integral to what is being priced. Now, the second recommendation is in effect a reporting obligation, and I want to come to that question now. Mr. Merciades mentioned it a short time ago in saying that the Australian government would have an interest in knowing what's been done with the money provided for increased staffing. But I'll start with you, Dr. Mellors, and I'll go to Mr. Thorley. There's a proposal here in recommendation 2 for the staffing levels to be provided in and that's recommendation 2 in the workforce submissions in February. Consistently in proposition FF12 for this hearing, there's a proposal for what's been called acquittal of direct care expenses. So Dr. Mellors, perhaps if we can ask the operator to bring up FF12 and we can take down the workforce recommendations. Dr. Mellors, what's your position? What's Regis's position on FF12 and related matters?
Thank you, Council. So Regis is in support of FF12 and strongly supports transparency around the spend of government funding. Again, I would just want to ensure that there is flexibility, particularly for the large providers, where there is centralised expertise and oversight, as well as staff who are in a particular home, but otherwise supportive. Would you like me to address the payment in arrears component as well?
I think we'll pass over that because we're probably going to run out of time, but thank you, Dr. Mellors. Mr. Thorley?
I think, excuse me, transparency is absolutely critical. I think the community and certainly the government has got a fair expectation, an appropriate expectation of transparency. In terms of the comments being made earlier by Dr. Mellors, I support those. I think a metricated approach to ratios has got to be cautiously thought through. I agree with Dr. Mellors in that the same ratios can achieve different outcomes according to leadership, management, culture, technology, and a whole range of factors. And I think it's got to be really carefully thought through. Any feeling that there's a linear transgression of ratios and outcomes. But I do go back to something that I've said on a number of occasions during the course of us being here today, and that is absolutely irrefutable that the appropriate level, skill, qualification of staff is important for good care outcomes.
Thank you. Mr. Merciades?
Thank you, Council. I think I've indicated already that greater disclosure is fundamental to the system going forward. But I'd have a bit of a concern about the use of the word acquittal, because from my experience in the public sector context, it refers mainly to grant-funded programs where you're looking to ensure that what money was provided was actually funded and was actually provided, and if it wasn't provided and there's underfunding, the money is returned. I think that doesn't work in the sort of aged care system that is being contemplated, where pricing based on benchmarked efficient delivery is the basis for the funding system, and also a system that incorporates incentives for efficiencies and labour productivity. So I think it's the use of the word acquittal that's the issue for me. So I'd prefer to see it in terms of greater reporting and disclosure to both the Independent Pricing Authority and to the Quality Commission.
Thank you. Mr. Merciades, I want to stay with you. I just have a very pithy question. Independent pricing, should it be determinative or just a recommendation to government?
Well, if I've taken a narrow aged care perspective, I'd say it should be determinative. But the reality is governments have to balance a lot of priorities. And I noticed looking at the sweep of propositions, there's a very significant role for the Pricing Authority in terms of influencing the Commonwealth budget through a wide range of these propositions. So, from a narrow perspective, certainly. Whether the government can live with that's another matter entirely.
Dr. Mellors, would it shake confidence, and after all, instilling confidence in the future sustainability of these funding streams and therefore of the system is integral to this whole exercise? Would it shake confidence if the role of the independent pricing body was merely recommendatory?
I think it would be problematic given the history in this sector. Like Mr Messiardi's, through an aged care lens, it would be ideal if the Independent Pricing Authority could determine prices. If that's not possible, for reasons that we understand, then there should be public disclosure of the recommendation from the Pricing Authority and government response, so that there's a level of accountability back to the community.
Thank you. Mr Thorley?
Mr Gray, I think the second favour determinative approach, that whatever it might be, the work of the Independent Pricing Authority, how it does its work, its scope, and then the recommendations that it might make to government, if that is going to be the process, should be very transparent and very apparent to the broader community.
Thank you. Now, I'm going to jump over accommodation. If we have time at the end, I'll come back to it, but I need to go to some other aspects of financial reporting and their connection with prudential regulation. Now, you've all spoken of the appropriateness of greater transparency. Have you familiarised yourselves with our propositions PR1 and incidentally also 3 and 4 are relevant here on financial reporting? And I'll start with you, Mr Thorley. What's Estia's position on PR1 and 3 and 4?
Our view is that, if I can just familiarise myself with 3 and 4.
Yes, I'm sorry. 3 is for continuous disclosure, and I have a specific question I want to ask you about that in a minute. 4 is for a special notification requirement if there's an outsourcing of the management of the care operations of a particular service.
Certainly, if we start with 4, totally agree with that requirement regarding the outsourcing of management, and I don't know whether it's inferred there or not, but my view would be to be an outsourced manager. One should also be an approved provider, and I honestly don't know whether that's the rules at the present time, but it certainly should be if that's not the case. In terms of the general range of increased prudential reporting that is presented in these propositions, Estia is supportive of them. The requirement of higher level reporting for all approved providers is absolutely crucial for all of the reasons that have been described to the Commission thus far, and for the overall performance of the sector, but also the assurance that government and the community would want, because providers that fail are not good for the sector in terms of the individual impact that it might have on residents, but the overall sense of the community confidence in what we do. So, of course, being an ASX listed entity, many of the things that are incorporated in these proposals are part and parcel in what we're required to do, be it continuous disclosure and a whole raft of reporting standards. So, in general, supportive of all of these recommendations.
And Mr Thorley, as you say, because you're subject to continuous disclosure via the ASX listing rules and the Corporations Act anyway, it probably doesn't affect you to add a continuous disclosure requirement, although the way it's tailored, I suppose, might materially differ in some cases from the way those rules operate. But can I just ask you this? What should be the trigger point when it comes to something that might imperil the continuity of care provision? Because that, after all, is probably the fundamental concern that the system manager would have, that people in residential care might be imperilled by a risk to the continuity of the care being provided to them. What should be the trigger point? Now, can I ask you this? I assume that aged care providers generally are forecasting their revenues and their costs and should be in a position to be aware of forthcoming liquidity issues sometime well in advance. How might we craft a trigger for notification to the prudential regulator or the system manager or both to help guide and manage the risks so that any threat to liquidity is notified to those bodies well in advance of any curtailment of service provision?
I think the ultimate test is one of solvency, and one might consider that there should be more regular reporting than is currently the case, and that it should be more contemporary. That regular reporting should be potentially accompanied by a statement from that is a statement of an audit opinion of the entity's capacity to meet its ongoing obligations. So I think that could be the threshold issue, and of course there's a lot of detail to be built around that, but maybe that's a good starting point.
Maybe it occurs to us that may be too late, because there might already be insolvent trading provisions that apply at that point in time. If one has a liquidity problem and it's already apparent that one's unable to pay one's debts as and when they fall due, then arguably there'll be an obligation to cease trading at that point. We need a trigger point a little earlier, don't we?
Yeah. But if I go back to the frequency of the reporting that would be required, I would suggest that the annual-based reporting, as it currently is, the level of disclosures that are required, some of the structures of the entities that are operating within the sector in the way they, might be protecting their overall obligations, needs to be addressed. And I think if the body of these reforms are introduced, including, and I go back to more frequent reporting with audit opinions attached as to the likelihood of those organisations, all of the organisations being able to meet their forthcoming obligations, that would be an important benchmark.
Thank you. Dr. Mellors?
Thank you, Council. So I support what Mr. Thorley has just stated. I would add that we need to have some kind of a risk matrix so that data can be triangulated appropriately from the different sources of information. I would like to make the point that much of the harm that's done to residents, families and workers happens probably over the last year before a provider does become insolvent, as people are rapidly making changes to try and save their business. So it's not just the point of collapse. So I agree with you that there needs to be an earlier trigger. I agree with Mr. Thorley around the requirement for auditing. I think if you're in receipt of government funding, there ought to be a requirement for a level of auditing that meets the risk level of providing aged care services. I think there's also the element of cash flow forecasting. That would be another good metric. And I imagine that regulators would have algorithms that they could apply if there are sudden changes or trends that are evident in terms of some of these metrics that might require them to go and take a closer look. I'm in support of more regular reporting, and I would also suggest that there's an attestation process so that some of these questions are canvassed and are required to be signed off at the highest level of an approved provider that's been through its due diligence in terms of asking questions of its management team to make sure that it's providing appropriate information in that attestation.
Thank you. Mr. Merciades.
I don't think I can add anything more to my panellists who provide a comprehensive response. Thank you.
Thank you. Commissioners, I have run up right against time. I have one more question. I do apologise for overrunning.
Sure.
Is that all right? Thank you. It's about accommodation and the role of the regulator. We've already established that, when I say the regulator, I mean the economic regulator or the pricing authority. We've already established the position of all the panellists on the appropriateness of independent pricing for the accommodation supplement element in the charges for accommodation. And if any of the panellists disagrees with that impression that I've formed about your evidence, please do tell me now. No? Good. The key question here is whether the authority, or one might say the regulator, the economic regulator, should also have a role in any form of economic regulation of the accommodation charges, whether that be in the form of a lump sum deposit or a daily accommodation payment. And in respect of those amounts for non-supported residents. So just to recap, we have supported residents, and in respect of supported residents, the government is paying the accommodation supplement, and the regulator or the pricing authority will be on these proposals establishing what that should be. What about non-supported residents? Should there be some form of economic regulation of the charges for accommodation for those people? At present, there is a provisional ceiling, and a provider goes to an officer called the Aged Care Pricing Commissioner and seeks a waiver or an increase of the provisional ceiling, which is currently $550,000. And the Pricing Commissioner considers some information and may or may not grant that permission. The information is loosely based around the sorts of costs that have been incurred, land prices and so forth, but there are no prescriptive rules about how that is done. Should there be tighter regulation of accommodation charges for unsupported residents? Mr. Thorley?
I'd be of the opinion that the current system works well. I think the choice of accommodation for a resident is one that is fairly easily determined. One can go through a residential home and make an assessment on the amenity and other things that are being provided as part of that accommodation offering, and maybe other things that they observe by doing that. And I think that given the fact that there is then the choice as to whether they pay a DAP or a RAD, and that there's a 6-month period for them to finally, make that choice before, to make that choice, that seems to be also an adequate level of protection for the consumer to, organise their personal affairs or whatever they might be considering as part of that activity. But no, I think it works reasonably well. I was going to say, Mr. Graves, a proposal that SU put forward in our response to the work that EY did last year in terms of prudential issues, and that was the concept of a RAD DAP sort of instrument where the financial institution might administer the DAPs that were being paid by incoming residents, and that pool could be drawn upon according to an approved provider's capital needs or strategies. That is, they could draw a RAD or draw a DAP, and that would be managed by that pool. That would also speak to some of the things you were probably thinking about in terms of solvency, in that if an approved provider was not strong enough financially, that is, that they didn't have a strong enough balance sheet, that pool could prevent them from drawing a RAD, and that they would require to draw a DAP. So there's a number of elements that could be considered with that mechanism, should that be considered as an appropriate way of dealing with Rads and Dapps, and some of the issues that again have been brought before the Royal Commission as far as there are concerns about various trends that are occurring in the market at the present time.
Should the process by which the Pricing Commissioner might approve a higher accommodation charge be more prescriptive around the inputs, the capital costs, the weighted average cost of capital for the sector and so forth? Is it enough, in effect, for somebody from the Pricing Commissioner to just look at the material that's provided and possibly walk through a facility, as you suggested might occur?
Look, I think for all of the things that we need to address in terms of funding, financing and sustainability, it seems to me that the accommodation component, as we're talking about it here, has worked reasonably well.
Okay. Dr. Mellows.
Thank you, Council. So I would agree. I think the process does work well now. I think the threshold being set at a level that doesn't seem to be reviewed is a problem. So I would suggest that there needs to be a mechanism for a point-in-time review and then ongoing either indexation or review points. But otherwise, I think it works well where there is choice for consumers. The only time I would suggest more regulation is in a thin market where there is inadequate choice for consumers, that you might want to put in some additional protections just under those circumstances. But I think in the main, the current process works well.
Thank you. And Mr. Merciades, the final word goes to you.
Thank you. I agree with the comments made by my panellists that the current market-informed system for setting prices for non-supported residents is working reasonably well, and the associated protections. But I'd be looking to an additional protection, and that is to introduce funding following the consumer in residential care and uncapping supply, so that you have the added advantage of increased competition as well to keep prices down.
Thank you. Commissioners, I have no further.
Yes, thank you, Mr. Green.
I want to ask the dummies question, because it's been bugging me for a while. And that is, because the older person's home's excluded from the assets test for pension purposes, you can be a pensioner with a quite expensive house, $1 million, $2 million and so on. In those circumstances, do the providers who work in your group or your group itself, in the case of Dr. Melas and Mr. Thorley, do you charge a RAD for those people to enter or not? Because they're pensioners.
So I'm happy to start, Commissioner. So the means and asset tests that are conducted and administered by government departments will tell us whether we are to treat the person as a high means, moderate means or fully supported. So we don't have discretion in that regard.
Okay.
That's good.
So basically, a full pensioner can have, or a part pensioner can have that very expensive house, and it's not brought to bear as part of this arrangement. That's really what you're saying, isn't it?
That's correct. I would suggest that there needs to be a review of the means and asset testing arrangements.
Yeah,
we agree with that, and without that issue of the family home that's described or principal residence, I think excluding that in the way that it's currently done places a greater burden on the taxpayer, because limiting its and also limiting its assessable value to 171,000 is iniquitous and does put more pressure on the taxpayer.
Thank you.
Well, thank you to each of you for the time that you've given us. You can see by the questions that we've asked that they're very important matters that you've been able to assist in our deliberations. And we're conscious of the time that you've put in before today and in the preparation for today and today. So thank you very much for all of that. And I need formally to excuse you from further attendance. So thank you.
Thank you.
Thank you, Commissioner.
2 o'clock? Is that right?
Yes. Thank you.
Until 2 o'clock.
Oh, my instructors made a suggestion that 2:15 would be appropriate if the commissioners wish to adjourn.
There may be a problem with the other end is the only difficulty.
Yeah, very well.
Yeah, I've got meetings. The Royal Commission is adjourned until 2 p.m.
Paulson.
Thank you, Commissioners. I call Mr Jonathan Gavshon and Ms Natasha Chadwick.
Mr. Gavshon, do you solemnly and sincerely declare and affirm that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Ms. Chadwick, do you solemnly and sincerely declare and affirm that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr Gavshon, could you state your full name for the record, please?
Jonathan Gavshon.
And you have prepared a statement, which, if that could be brought up, please, it's WIT 1357 0001 0001. And you recognise that as your statement?
I do.
And to the extent that contains facts, is it true and correct to the best of your knowledge, information and belief?
Correct.
And any opinions that you hold or are expressed in that statement, you honestly hold those opinions. Is that correct?
That's correct.
Ms. I tendered the statement, Commissioners.
Exhibit 2121.
Ms. Chadwick, if you could you please state your full name for the record?
Natasha Jane Chadwick.
And you have prepared a statement, WIT 1361 0001 0001. Recognise that in front of you now?
I do.
And are the contents of the factual matters asserted in that statement true and correct?
Yes, they are.
And are the opinions that you state in that statement honestly held by you?
Yes.
I tender that statement.
That's Exhibit 2122.
Although you've both given evidence to the Royal Commission before, I thought we might get an overview from each of you about the particular innovative and individual ways in which each of your organisations deliver care. So, Mr Gavshon, I'll start with you. You're the co-CEO of Group Homes Australia. Could you give us a summary of the group homes concept in aged care, please?
We operate a traditional home in a traditional suburb on a traditional street. So our homes are catered to people living with dementia. They cater for anywhere from 6 to 10 residents at a time, and they receive 24-hour care in this environment. And we believe that this environment, being a home that looks, feels and smells like a traditional home, should be really beneficial for the residents living beyond their dementia diagnosis. And we engage with them in purposeful and meaningful activities around things like the cooking, the baking, the gardening, which all give them a sense of purpose around the home.
So the people that come and live with you, they live in the home full time?
They do.
Do they fall within the rubric of residential aged care though?
They don't, because our homes are on traditional streets in traditional suburbs. And so our model and the funding that they receive is akin to residents that are living in their own home and receiving home care packages.
All right. Ms Chadwick, New Direction Belmere is slightly different from Group Homes Australia. What makes your particular way of delivering aged care different?
So my evidence and the way that we deliver care at New Direction Care is that we developed a microtown model. It's one of the most innovative models that's operating in residential aged care today. It is essentially a residential community for elderly people and those that are living with younger onset dementia. It's framed around a town, like any small town in Australia. It has 6 streets. And on those 6 streets, there are 17 houses, and those houses are mini care homes. They accommodate 7 residents in each of those care homes. And they operate just like your home or mine, and they look just like your home or mine. So, you walk through the front porch, through the front door, into a lounge living area, the kitchen's available, the lounge and dining areas. You walk outside into the back garden, and in the back garden we have, you know, the quintessential barbecue, good old Aussie kind of environment. So the great part about our model, if you like, is that it is formed as part of a community. So residents are, yes, in a small house model, there's only 7 of them. However, they also become part of a much larger community, and that community has got support services like hairdressing salon, GP and wellness clinics, you know, dental clinic. It has a corner store which we purchase all of our housing needs from. It also has a cafe. So essentially it's its own little town.
I expect that each model of care requires a particularly specialised level of staff. Could you give us an indication of why the staff that we might see at each of your facilities is different from the traditional mainstream model of care? Mr. Gavshon, why don't you start first?
That's a great question. So our model centres around the role that we call a homemaker. That homemaker is a 24-hour care worker, and they really develop a strong relationship with each and every resident in the home. We're very, very focused on the fact that we don't engage or employ any agency staff. All our team members are employed directly by us, and they're required to work at least 3 consecutive days on the roster. And what that does is it gives a sense of continuity and a sense of familiarity to the residents. So if I was to, if they were to walk into a shift and really need to understand the care needs of those residents, they can do so because the roster is so stable. What that does is it also allows us to invest in them and train them and develop them with core skills. Underpinning this is a whole level of clinical care that we also offer, because our residents are able to stay in our homes through to end of life. And so we have a full support team that are engaged to support these homemakers. Part of this support team are registered nurses, social workers, and other team members who all provide that oversight and support, but they're not on site 24 hours a day. The homemakers are the ones that are driving the frontline care.
And what are the typical qualifications and training of your homemakers?
The typical qualifications are that of an AIN to Cert 3 or Cert 4. But I have to be frank with you that we also will look to people that don't have prior experience, because what we find is that they are then able to be trained and developed in a very different and unique way, as opposed to coming with a deep level of experience or training, which sometimes needs to be unwound in the nature of our innovative setting.
All right, well, let's turn to your organisation, Ms. Chadwick. How different is the staff profile at your organisation compared to what we might see in a more traditional?
So we have a role that is called a house companion, and that house companion is works typically only with the one house with those residents. So again, very much based around relationship and connection. The house companion role is multifunctional, so they operate the household budget through to personal care. They deliver medication administration, they do cleaning, catering, laundry, menu planning, provide emotional support to residents. And, you know, they pretty much just manage that household and the residents that are living within it. In terms of the differences, we also then have 24-hour support from a clinical team, but it's on site. So it's in our community, and they can quickly respond to a resident's need, you know, if they require that. So we have registered nurses, we have ENs, but big part of our model is actually around our allied health staff. We utilise occupational therapists, physiotherapists, and other allied staff. And you know, even though they may be a more costly team member, they're actually also more valuable than just adding, you know, another RN to a shift, for example.
Let's then talk about how all of this care, this different level of care is paid for. Mr. Gavshon, you rely on home care packages assigned to your individual clients to fund all of this. Is that enough to meet the costs of the organisation?
It's not sufficient. We do, as you said, rely on that funding. And just like someone could receive 24-hour care in their own home and put their home care package towards that care or the costs of that care, so too can they do so in our traditional home with our care costs. But where we feel that it's the current funding approach is problematic is that residents that were to move into a residential aged care facility, and let's say that they're at an equivalent high, medium, or an AC fee of roughly $200 a day, the equivalent funding for them under the home care package program is only around $150 a day at the level 4 level without any means test applied. And so what you can see is that depending on their choice of setting, they get inferior funding from the government as opposed to that being equal across the two choices.
Thank you. Now, you make reference to this in your statement. When we asked you to indicate a way ahead or a proposal for reform, I think you talked about forum-neutral funding. And perhaps we could bring up paragraph 85B of Mr. Gavshon's statement on page 0014. You say there that funding for residential care should transition to a consumer-directed model in which the consumer has access to the full range of available providers and a choice of care and support services. And then you go on to say at C, there should be a single funding model of care to ensure that there are no funding gaps throughout a resident's journey. Why should there be this single continuum? What makes sense about having a single funding continuum?
That's a great question. We believe that people should be able to receive the care when they need it, at the time that they need it, and that it should be setting agnostic. So I refer back to some of your previous hearings where Professor Eager references some of this in her statement and her testimony. Our belief is that something along the lines of a voucher-based system would be much more constructive in the context of allowing people to receive the right care at the right time. It might be helpful if I give you an example of a resident and their experience just to try and illustrate why we feel this is so important.
Please do.
We had a resident that lived in a retirement village. At the time, she was living without a dementia diagnosis. And fast forward a couple of years during her stay at this retirement village, and she started to show signs of cognitive decline. Her family went and got a diagnosis, and very shortly after, the retirement village operators indicated to her that it might be time for her to look at more permanent care in a residential aged care facility. While she was living in the retirement village, she was receiving a home care package, and that was adequately funding some support for her to stay there. When she moved into the residential aged care facility, she had to give up that funding and then activated, obviously, the funding through the residential aged care stream. But the family quickly realised that that wasn't the best option for her, the locked dementia ward. And so they started to look at other options for her and found Group Homes Australia. And when they found us, they then needed to go and reverse that decision and reactivate her home care package. And that became an administrative nightmare. It's no surprise to this group that the wait lists within the home care package program are extensive. And so she had to go back on the national queue to receive that. And so the fungibility of her funding was obviously not there, and therefore it made it really problematic for her to navigate to and from the two different systems. Another element where it's also challenging is under respite, because respite is only currently delivered under residential aged care rather than in different settings. And our belief is that if you can help support someone through multiple respite stays to help extend their stay in the community, that's a critical opportunity that's obviously being lost because of the nature of this lack of single funding continuum.
Right, thank you very much. We might turn to Ms. Chadwick. You receive ACFI funding for your residential clients.
Yes.
How fit for purpose is ACFI funding at the innovative end of the delivery of care?
So, as I've said in my statement, I don't believe that ACFI is any longer fit for purpose. One of the main reasons for that is, particularly in a model like ours, we focus on what a person can continue to do and still do in their life, as well as the areas that we might be able to rehabilitate, if you like, or re-able. And so an ACFI model or ACFI funding is based on disability. It is not based on ability. And the minute that we actually, increase a person's capacity and they're able to now undertake a task themselves with support, we lose any funding. And so, that's one of the biggest issues that we've encountered as an innovator, someone who has innovated and within the aged care regulation in the current environment. ACFI funding has let us down substantially to the point where we have to cross-subsidise to make a return.
Could you perhaps give us an example of how that plays out, where you aren't rewarded for doing the right thing with someone and how it affects your bottom line?
So let's take, for example, someone who has mobility issues. If we get them out of a wheelchair and rehabilitate and they're actually back up and able to weight bear and stand and potentially take a few steps, then we're penalised for that, because all of a sudden they're no longer hands-on or immobile, and all of a sudden they're being supported. But in our view, being supported to do something yourself actually takes longer, is better for the person, and provides them quality of life, not just quality of care.
Well, that then turns to an important question, a question of principle. How should the Royal Commission view the important task of funding for innovation? How should one fund innovative models of care? Should they be incentivised in the funding model? What do you think the focus of attention should be?
So I would say, and this is coming from a reference of my lived experience as an innovative provider involved in aged care for over 25 years. And I've worked across a variety of providers, not-for-profit and profit. I've consulted to the industry and lobbied for and on behalf of its consumers. I think if you talk about innovation, let me just take you to our model, for example, at New Direction Care. There are probably three major components that need to be considered. One is the built environment, and I've described that previously. The other is the technology that we deploy in providing greater efficiency for our staff, but also enabling residents to have privacy and also freedom of movement and independence. So, for example, we have a layered mobile monitoring system, which includes CCTV, watches and sensors for residents. Staff also have a communication device. Now, all of these things had a significant capital upfront cost, which was in the building development, but they also have a ongoing maintenance and licensing cost. And so those kinds of things need to be incorporated. We also don't use them to replace staff. We use those methods, if you like, to ensure that our staff are fully utilised at the point of care and where residents need them to be, rather than trying to find each other. We don't do rounds, for example, and particularly at night. When residents should be sleeping, we let them sleep. And so this kind of technology lets us, know when a resident requires us. They either call us, there's an alarm that comes or an alert that comes through to the systems, and we can then intervene rather than doing rounds, as I said. The other thing that I think is really important that needs to be taken into account, particularly around an innovation like we have in our New Direction Care microtowns, is that and I think I outlined this in the differences paper to traditional aged care that I submitted to the Commission. We currently provide about 5.37 hours to indirect care, which includes 77 minutes of RN-EN and about 35 minutes of allied health. Now, that's against a 2.86 average that's outlined in the ANF Aged Care Survey back in 2016. Now, I know it's marginally increased to about 3 at the moment, but that's a significant difference. And it's simply because we utilise our staff in a multifunctional way rather than the delineated way that is used in traditional aged care. So our house companion, for example, does all the things that a carer would do, a cleaner would do, a cook would do, a person in the laundry, someone doing admin. And so all of those things are wrapped up into one person, and they do it with a resident to the extent that that resident is actually able and capable of doing those tasks as well. So it's very different from traditional aged care, which is task focused and to a person. So those are the kinds of things that I would suggest need to be considered when we're pricing or looking at innovation. Those are the innovations that we've implemented, but again, it's across the board. Everything that we touch in aged care, we have innovated in some way.
Mr. Gavshon, how should the Commission approach funding for innovative models in aged care?
I think within the context of this question, it's important to take a step back and look at the structures at play and see whether they actually fundamentally support a level of innovation. And so our recommendation or perspective would be is that they currently don't. And that innovation needs to be supported through whether it be the pricing model, whether it be the funding model, whether it be the acquittal and regulatory model, to see if that as a system is actually promoting and stimulating that. Because what we believe is that you can look at elements of technology and you can look at other elements from an innovative perspective in terms of what's being developed out there, but ultimately, if the structure is not supporting a level of innovation, it's very hard to deliver that. We also look at innovation in the context of care approach and how unmet needs are being met. So again, if I may, to give you an example, we had an individual that was at a traditional residential aged care facility, and he was being coined as showing elements of behaviours or aggression. And when he came to us, we refer to these as unmet needs. And when we delved into the deeper level of what actually he was as a person, how he liked to receive his care, what we identified is that he in his prior career was a tradesperson. And so what we did is we got buckets of paint and paintbrushes and tools and allowed him to paint the fence and get involved in handyman related activities around the home. And that had a completely different impact on his care experience within the context of our home. And so while you can kind of look at pieces of technology, which I can give you examples of, we also look at it in the context of, is the actual structure, is the funding ultimately supporting a different and innovative way to how care is actually being delivered?
We might turn now to a number of the propositions which you've had an opportunity to review. If we could go firstly to propositions FF 5 through 7, which you'll recall, 5 deals with funding through a combination of block and activity-based funding. 6 is individualised bundles. And 7, a case mix adjusted activity-based funding arrangement. Mr. Gavshon, I'll start with you. What's your overall impression of that sort of approach to funding?
In principle, we're supportive of the propositions that have been put forward here with a caution. And that caution is around the element of activity-based funding and how granular that is going to become. So I think Ms. Chadwick mentioned this as well. When you have a universal team member, such as a homemaker or in her instance, a house companion, we need to be quite cautious about supporting a model which gets to the level of granularity that precludes an element of funding that can be more kind of universal within the context of the worker and the environment. And so, yes, we can absolutely work within the context of block funding and case mix funding, but we are very cautious about how granular it becomes when you look at the activity-based level. We have the benefit of having the experience of being both a home care approved provider as well as a NDIS registered provider. And what I can share from you from that experience in being an NDIS provider is that that is very activity based and very granular in its approach. And that has been very challenging in the context of our format to be able to tap into the different funding streams and equip them appropriately, which we believe would then lead to stifling the level of innovation and compromise our ability to deliver the right care.
Well, can you give us an example of that? It's been said by some people that that sort of approach can often lead to casualisation because of there's a particular emphasis on particular skills. Do you have a view about that?
Sure. So an example of that is where a participant will get a plan with in total a large funded amount, but because it's been broken down into very granular levels of activities, and sometimes those activities are not required or might not necessarily be what's relevant for that particular point in their care journey, that funding can't be tapped and they've exhausted their funding in their other buckets. And so what ends up happening is, while in principle, the government or the department's been comfortable to approve an aggregate amount, we actually can't tap that aggregate amount because the granular breakdown has not meant we can actually deliver that care.
And that would be a particular concern, I take it, if you are unable to reach those funds. Does that happen at the moment with home care packages?
No, because with home care packages at the moment, the funding is not sufficient to cover even close to the quantum of what needs to be funded. And so it can always be deployed. And also because it's consumer directed and it can be applied very flexibly, it does work. But I'm referring more to the NDIS style structure.
All right.
To give you an even more specific example, if someone needed a level of rehabilitation and allied health support and needed a physio and had physio funding, in our model, the way we would approach it is that the physio would come and give a very comprehensive overview of a care plan for a resident. And then given the continuity and stability of our homemakers could take an element of responsibility around implementing that care plan that the physio has outlined. In the context of this funding model, only a physio would be able to deliver that care or that support, and you would compromise the ability for the universal worker to be able to deliver and add value to that person's care.
So I take it that would become particularly pertinent if Proposition FF8, which we haven't come to yet, but which says that the maximum funding amount for care at home should be the same as the maximum amount of care funding inside residential aged care, which I expect you'd be happy to see. If there were barriers in terms of the granularity that you're talking about, that would be something that needs to be worked through, I take it.
Correct.
Okay, thank you very much for that. We might turn to you then, Ms. Chadwick. Let's go back to propositions 5, 6 and 7. You have obviously a very different model of care. How would you see 5, 6 and 7 applying to a new direction?
So I think there are a number of things that need to be considered. One is that the individual components are also looked at. You know, an individual resident has very different emotional needs, for example, from each other. It's a very individualised requirement. And so I would just be wanting to make sure that there is that ability, that the fixed cost as well as the adjustment or the activity-based. I'd be concerned about things like how end of life would be treated. It's very difficult to obtain, true end of life funding in the current environment, even though care and support services increases significantly, particularly in that last 6 to 8 weeks of a person's life, if it's planned, and we know that they're at that stage. And that brings to mind supporting family as well, not just the resident, but the family around them, to make sure that those things are also included. I think some of the issues around like for like, and this might more into FF8 as well, but if we're going to be agnostic of location, then I think we need to be very careful that it's like for like service. Having a registered nurse and a full complement of staff on site overnight is very different from having a sleepover who might have on call to an RN or be required to call an ambulance or something like that. So I would just be cautious, if you like, around making sure that we are pricing those kinds of things appropriately or funding them appropriately.
We'll come to FF2 in a moment, but Mr. Gavshon, assuming FF8 was found favour, wouldn't you in effect become a residential aged care provider with sufficient funding?
It's a good question, but ultimately core to our philosophy is the fact that we're a traditional home in a traditional suburb on a traditional street.
Why is that important?
Why is that important? Because we believe that the care environment is a critical component to the therapy that's offered for these residents living beyond a dementia diagnosis. The other thing that we think is important, and again, I draw you back to Professor Eager's evidence that she gave earlier in this session, is that we are also able to draw on or rely on community infrastructure rather than having to develop our own infrastructure within the context of the care facility. And we believe that is a much more scalable and much more beneficial model for the resident with dementia. The local cafe is the cafe that the residents go to. The local aquatic centre is the aquatherapy place that they go to, rather than having to build this all independently, which is not a sustainable model for a society.
Thank you. I'd ask you each now to comment, please, on proposition FF2, which is the funding for direct and indirect costs. If we could call that up, please. It's on page 3. How would that sort of mechanism for funding indirect costs assist an organisation like yours, Mr. Gavshon?
At a big picture level, we're very encouraged and supportive of the proposition on the basis that funding would go to both the direct and indirect nature of our cost base. But where Ms. Chadwick mentioned, and I support her perspective as well, is that our universal care team member or our homemaker does a fair amount of this indirect work, whether it be the rostering, the budgeting, or things that would traditionally fall under the indirect category. And so again, I ask for caution with respect to the application of this, because we feel that if we get too prescriptive about where these costs need to sit and how they need to be acquitted, the innovative nature of our model would be compromised.
Is it possible, do you think, to ring-fence particular models of care that are established as being progressive and innovative, that recognise people's choice, such as the two models you operate, and providing a different approach to their assessment of costs when compared to more traditional, more intensive operations?
So that goes to the core of the question around how to support innovation and how the funding model can essentially apply to that. Our belief is that you don't need just a blunt pricing model, and we also don't believe that we should be ring-fenced as innovators, because ultimately you want the entire industry to be focused on innovation and a level of disruption rather than just ring-fenced a particular number of players. So we believe that layering in a number of parameters, such as what the setting is, what the unmet needs are that are being addressed, what the complexity of care is that's being offered, what training and development's being offered, what the quality of the meals and the level of engagement is that being offered, all needs to be play into the funding model and the overall system, because that ultimately can then deliver the most choice for participants and therefore the most trust in the system, rather than compartmentalising the way that some of these propositions are working.
It's one way of putting it that the assessment of costs has got to take into account at least from some broader policy perspective, the model of care that's applied?
Absolutely. Absolutely. I think the model of care, but providing choice within the context and flexibility around that model of care is absolutely critical.
Ms. Chadwick, where do you sit on this and funding proposition 2?
So, I mean, in many respects, we have the same concerns, Jonathan and I, or the group homes and I. I think, though, it's really important that, as Jonathan said, we don't ring fence just the innovation that's there today, because tomorrow there could be very different innovations within our sector, and we really need to ensure that the structures are set up so that, we don't stifle that kind of innovation moving forward. One of my biggest concerns is that if we make it hard within the Act and the regulations to provide innovation, then people, operators, if you like, will move outside of the Act. The real concern with this is that government and consumers then have no recall whatsoever. So, for example, it would not be in the interests of government or consumers for operators to collect significant lump sums, similar to Rads, and promote themselves as a nursing home, but not actually be captured under that particular regulation, or even other regulation that would capture them. So, that's something that I would just caution around. We don't want to have people sitting outside of the regulation, and it should be discouraged with our system design. At New Direction Care, we've innovated within the aged care legislation, and sometimes it feels like we've been penalised for the privilege of doing this. So yes. So in terms of direct and indirect costs, though, I think specifically our staffing models do speak to that. We have a worker, a person who is purchasing food, menu planning, delivering the meal, doing the cleaning, doing the laundry, all of this with a resident, so that that resident can continue to live as normal a life as possible. And if we start to really pull out direct care costs versus indirect costs, I'm not sure how a model like ours could be, one, properly priced, and two, acquitted.
Ms. Chadwick, in your statement, have some concerns or some misgivings about the ANAC approach in the case of innovative providers. Could you just develop that, please? I think at paragraph 64 you introduced that topic, and it develops over a number of paragraphs following that. What's the danger in an ANAC method of allocating funding?
Well, and I've said it, a number of times. Is in my witness statement and over the course of discussions, is that many of the funding studies, including the ANAC CC, they're based on what currently happens within the traditional aged care environment, and so that's very concerning. In that, if you haven't even considered innovation in those studies, how can you determine what is the best funding tool to actually, ensure that innovation can continue? So that's probably one of the biggest concerns. As I said, they look at how traditional aged care is delivered, task-focused, if you like, rather than how it could be delivered. So it's not really reimagining what aged care should be doing. There's a lot of differences in ours as well with respect to that. When you look at fixed funding, for example, as I said, if a night supervisor is fixed, the New Direction Care model brings care and support in as needs arise in a house, and work with an individual. So I'm just not sure that individual requirements would be fully catered for, and that possibly we need to look at getting some innovators, if you like, to also assess whether or not that particular funding mechanism would work.
All right. Well, you've had a look at our propositions. Other than the matters that you've already addressed, Is there anything else that you think that we need to think about, or that the Commission needs to think about, to better cater for innovative models of care?
So I think some of the acquittal and prudential suggestions could mean that there's a large increase, particularly in indirect costs around administration and financial oversight. And for innovative or smaller providers, that could potentially create some disincentives. And also, at what point do you cost yourself out of the market? There's only so much cost that any system, if you like, can bear. So it's just about understanding whether or not those costs are a benefit and that the benefit outweighs that cost.
And was there a particular proposition that you had in mind to draw that out?
Sorry, that was just talking more in terms of prudentialing and the acquittal processes that were being suggested in a number of the propositions.
Have you had an opportunity to look at the continuous disclosure prudential propositions?
Yes, I have, yes.
And what's your reaction to something along those lines? If there was, say, a significant downturn in occupancy, or there was a material change or a significant change in your budgetary performance as you anticipated it going forward over the course of 3, 6, 12 months, should there be an obligation to at least let the prudential regulator know of that concern?
I think, again, there's a lot of information that's currently within our sector that is provided to the department or to the relevant regulator. And maybe it would be better to look at how they could utilise that data, not necessarily, that constant reporting. I think that in the main, we have these kinds of relationships with our financing or funding institutions. I mean, New Direction Care, even though it's an innovative model, was funded very similar to a traditional aged care environment. And, we have extensive disclosure requirements with our funding or with our financier around the same kinds of things. So, I just don't want to see, like I said, additional costs. This kind of continuous reporting means that, we become akin to a small provider needs to have very skilled financial assistance and staffing. So it adds to the cost to be able to deliver that information.
Mr. Gavshon, you don't have to worry about prudential regulation so much, do you?
Look, we welcome regulation, especially from the standards and also from the financial perspective. If I could maybe respond to PR1 onwards, our feeling is that the acquittal process, if it's a proxy for measuring quality, is probably not the right proxy to be using within the context of a true kind of holistic assessment of what's being delivered. We also feel that with the level of acquittal that's being proposed and the level of continuous disclosure, it does also present a problem for the innovative operators. And again, if you wouldn't mind if I could give you an example here. Oftentimes the department sends out very specific templates that they require completion in order to assess a certain, call it funding stream or essentially the health of the sector or the industry. And as an innovative operator, it's very, very difficult sometimes to populate those templates because they're structured for the traditional sector and are not structured in a flexible way. And so again, I provide caution here around taking that approach when the innovative operators sometimes can't actually convey their message of health because purely the structure of the spreadsheet is not flexible enough.
Ms. Chadwick, a simple liquidity measure or a occupancy measure or a performance against budget where there is a material change would not be may I suggest, a relatively onerous thing to report. It's likely that you would have to disclose that to your bank. I'm not talking about you, I'm talking about the reasonable aged care provider. It seems to me it's a small price to pay to make sure that there is that the regulator knows when there is a problem on the horizon with a provider. How do you suggest there should be some sort of an early warning system about liquidity issues for smaller providers? And we have seen evidence that these are not insignificant matters in the eyes of the current prudential regulator.
Sure. Look, I am not opposed to stronger regulations. Please don't get that from my messaging. I'm just asking that we are cautious. I would ask the Commission if it has considered, particularly around prudentialing, some form of insurance scheme. I know that that's something that was put forward to the industry many years ago when RADs were first came into being, if you like. So I think that there are other ways or things that we could do that could deal with those particular issues. I think that, we can't forget that aged care, particularly in this current economic environment, is one of the biggest growth areas for the Australian economy moving forward. And what we don't want to see is, that growth being the same old same, where innovation and the ability to innovation is not allowed or not incentivised. So I'm just cautious around making sure that we continue to support innovation, because as someone who has done it within the regulations that we currently operate today, including prudentialing, I would hate to see the capacity for growth be stifled as well if we had to hold a large number of capital, if you like, just sitting there for liquidity purposes. So I'm just asking, for consideration of other measures, that's all.
All right. Was there anything else either of you wish to say about Proposition FF8 and what it might mean to your respective organisations? I think we may have covered you, Mr. Gavshon, but what about you, Ms. Chadwick? Is that something that you wish to make any comments about?
FF8. Can we just revisit the proposition? I'm sorry.
If that could be brought up, please. So FF8 is it's really more about home care.
Mm-hmm.
But I'm concerned about a small provider such as you, your reaction to the fact that people would be able to get the same amount, the maximum amount for home care as they would get for the care as if they were in a nursing home. So that would mean that there would be significantly more funding for people to age in their home. And I'm just wondering where you see that might affect the market and for residential aged care in the future, particularly at your end of the market, the smaller provider.
Okay, so I think the biggest point that I was making when we first touched on this was that I think if we're going to do that, it has to be a like-for-like service. And I don't know whether that's actually achievable within a home environment to the extent that it is achieved in a residential care environment at the highest end. So, for someone that might be living with severe dementia, for example, I have in my evidence provided or in my witness statement provided, 2 homes, if you like, and the different costs that go into providing care for different people at different levels. And so, like I said, I would just be looking for, the funding is set on a like-for-like basis. It needs to take into account the fact that, we have a staffing model that is quite different. It needs to take into account potentially that there is staffing, depending on whether you are NFP or FP, that has a different cost attached to it as well. So, there's greater opportunities for a NFP to provide more staff, if you like, at the same cost of an FP for less staff. So all of those kinds of things need to be factored in, I would say. I'm not I'm agnostic as to location. I agree that if I require the same level of care at home and I'm receiving it at home, then I should be funded for that. My question is whether or not that is actually achievable.
Okay, thank you. We might move on.
Bolster, if I could just add briefly that I concur with that, but what I feel is important to emphasise is the fact that this choice and flexibility is critical, and ultimately providing people with that choice, given that the majority of Australians today, as they age, would probably elect to be at home, whether that be a group home, a microtown, or their own home, is ultimately what they're after. And so aligning the funding system to support that demographic shift, but also that desire, is what I feel is important, rather than just having a higher funded amount within a residential aged care facility and not the applicable amount within the community.
I guess the point of me raising the question is, assuming it's like for like, and assuming it funds the same level of care, leaving aside the difference between standard care and perhaps a more innovative model of care, but assuming it is like for like, do you think that there will be even less demand for residential care moving forward under that sort of proposition or policy?
Look, I think there's a potential for that to occur, absolutely. But I also think that there is a recognition within the community that sometimes you can't provide, even with a high level of assistance, sometimes you can't provide that level at home. So, let's take an example of someone who is living with dementia, has certain unmet needs, or responsive behaviours, and becomes all of a sudden a safety issue for their family, even with significant amounts of funding or care being delivered into the home, unless it's 24/7. That could potentially create greater safety issues for not just the resident, but also the family members that they're living with. So that's one resident or person that will continue to need residential care. There are also many other people who don't have support networks at home and within their community. And so social isolation, loneliness, those factors need to be considered when you're talking about delivering care into a home. So certainly it's a potential. But I also think that organisations like my own, where we're innovating, we are providing, that point of difference, because we are essentially that person's home, but we've also created a community for them to become part of.
All right, let's turn, can we, to accommodation funding. Ms. Chadwick, are you assisted by the accommodation supplement?
Yes.
Could you explain how significant it is to your operations?
Well, we currently operate with about 42% of our residents that are financially disadvantaged or socially disadvantaged. So we do receive the funding from government, around $58 a day. We then also have Rads, so our Rad or a Dap. It's a significant part of the return to the organisation so that it can replenish, if you like, the built environment and the model as we move on, as well as our growth.
Do you prefer RAD paying residents over non-RAD paying residents, or are you agnostic to the means of funding when someone applies to come and live with you?
I think it's a much bigger question than that, because it depends on your structure, your setup. It depends on the banking or financing arrangements that you might be able to enter into. And the majority of banking arrangements these days require the use of RADs to pay back the financing, so that in 3 to 5 years, essentially, there is no debt sitting with the funding institution or the financing institution. So if you ask me that question, we have substantial RAD holdings, absolutely. We meet all of our prudentialing requirements, and they have been a big part of why the model was able to be developed in the first place, because it was the one thing that the banks that funded us could go back to and knew that they would be able to, extinguish their debt at some point.
Mr. Gavachon, how does Group Homes Australia fund accommodation costs? You don't get any money from the Commonwealth for that, do you?
We do not. We see the accommodation contribution as a component of the ordinary costs of daily living. And so we charge a nominal bedroom rental for our residents, but we don't charge a large fee for that, given that the majority of the care and the cost of their stay is really borne out of the care rather than the accommodation.
What's the sort of the rental fee a week for one of your residents?
It's underpinned by the location of the home. So a home with a harbour view in the eastern suburbs is a very different price to a home in a suburb further away from metropolitan Sydney. So we price it accordingly and adjust it in that way.
What's the? You're a for-profit provider, of course, correct?
Correct.
Where does the? And you don't have to answer this if you don't want to, but where does your business model get the return that it needs on the capital that's been invested? What segment of your revenue is the most significant part? Is it what you get from the customers through this rental, or is it the funding from the Commonwealth?
It's neither. Without it going into a large level of detail, we don't make a large profit from the accommodation contribution. The primary source of revenue for our business is the care component, and this is also the primary source of our costs.
Yeah. All right. How should the government fund the accommodation costs for that sort of organisation?
We believe that the current funding arrangements are sufficient in that essentially it's covered by someone's pension if they are a pensioner. Otherwise, it is an ordinary cost of living, and in the same way that they would have funded their own private home, they would fund their own private stay in our group home. So we're supportive of not having large amounts of government funding for this, and that the primary government funding being dedicated towards the care component.
Well, that leads me to the next question. Against that background, how do you raise capital for the purchase and the improvement and the remodelling of the homes that you buy?
So look, we're a private business, and we've raised private capital. And while we do charge a nominal bedroom rental, there is a small return that's generated out of that, and that's a sufficient return for our investors that have helped us to get this model up and running.
All right. Could a capital model of funding based on a weighted average cost of capital work better for Group Homes Australia, or is that not something that you're looking for?
The primary thing we're looking for is equity and fairness across the entire system. And the other thing that I would say is that we're looking for the primary kind of cost that we'd like the government to look at bearing is the care component. So as I mentioned before, in the same way that we think that individuals are subject to their own accommodation costs within the context of the community, we feel that government can lend the majority of its support and have the most impact through contributing to care.
Thank you for that. The last question that I have is about Proposition FF10, which is about funding to improve the quality of residential aged care homes. Which is if you look at that could be brought up, please, on page 7, you'll see that in the detail, it says that pending the implementation of a new case mix adjusted activity-based funding model for residential aged care homes, the Australian government should make additional funding available tied to an increase in staffing levels. Now, I gather from your evidence, you would say that you have the staffing levels to match the particular need of your residents and the particular demands, and that staffing is not really an issue for you. Am I right in thinking that? Do you agree with proposition FF10?
We believe that staffing is not a primary issue that underpins an issue of quality within the context of our model, because we do staff it generously on the basis that we believe that is an important component to delivery of quality of care. But this gets back to the question and the discussion we were having earlier around the assessment of quality, and also the ability to have an impact on quality through a number of different parameters, not just staffing. Because our view is that if you only look at it at a narrow level of increased funding for simply staffing, we believe that you compromise the overall look and view of quality. And so our view would be is that if you want to increase quality, you've got to look at a certain level of other parameters, whether it be complexity of the care residents, how many residents are being staffed within or being cared for within the context of that setting, what unmet needs they have and how you're addressing that within the case mix, what activities of engagement are being offered, what's the quality of the meals being offered, rather than just looking at the blunt pricing and, staffing component.
Ms. Chadwick, would you place yourself in that category of provider that needs to improve quality?
No, not in terms of quality overall. I think our residents would support that. We have a very high quality rating and CER.
But what about for the rest of the industry? What would FF10 serve a useful purpose?
So I think, again, not a blunt instrument. So there needs to be some flexibility around how that would be determined. I've talked about the differences in our model to traditional residential aged care, and ratios, if you like, or being acquitted for particular staffing could end up being quite restrictive. We engage professional staff, podiatrists, we've got RNs, ENs, we have the house companion role that's multidisciplinary, but it operates at a much higher level than a traditional carer. So, a greater value role and cost attached to that person is relevant, I think, when you're looking at whether or not those immediate funding measures and acquittal of them would actually do the job.
Can I pick up on what you're both saying? I fully appreciate where you're coming from. One of the challenges with any system of funding is it typically goes to program arrangements and rules around those program arrangements. The Canadians experienced a similar thing, and as us, and in one of the states that the Royal Commission had the privilege of visiting earlier in the year, one of the provinces, I should say, that local provincial government had a form of funding which was set aside for innovative services so that the sorts of disincentives that you are talking about didn't occur, and over time they were folded into the mainstream. And it just strikes me that any sensible system of program funding should be constantly innovating itself and developing so that the different models of innovation that occur aren't prevented from doing so. But that's not to say that there may very well be good reason to tie funding to an increase in staffing levels for some of the facilities that exist at the moment who aren't providing a decent and adequate standard of care because there simply aren't enough people on the floors. So what do you think of that kind of a variation?
Commissioner, I wholeheartedly support and am encouraged and inspired by that reflection and that opportunity for Australia, because what I believe is that that very nature of continuous improvement, which the industry is so closely held to within the context of the quality standards, is such a critical element in terms of how we can evolve and develop the sector more broadly. And so the piece that you mentioned around having this ring-fenced funding, but then needing to constantly incorporate it as things get tested and reviewed, I think would provide a wonderful way to continually evolve the system of aged care. If we look at how much many reports and effort and time has gone into innovation and change here, I think if you embedded that in the system, it would be a wonderful way to I guess, prevent in the future from a lack of innovation happening. So in summary, I completely support it.
So if I may, Commissioner, I also agree. One of the things that I think needs to be considered strongly is that to change, to innovate, or even to change the current environment within our sector, within the aged care sector, is that we need to also value leadership, management and administration support to the people that provide direct care and support, and the value that they bring to an organisation in achieving high quality as well, high quality in care as well as quality of life for the people that are receiving that care. You know, there are really important aspects of our model, and I think the same would be said for group homes, where how do you factor in for something like, our maintenance team role, for example, where a resident is supported in their activities right by every single person who works in the organisation. So, on any given day, the gardener might have a number of residents that are actually, working with them in a meaningful way. How do you incorporate those kinds of things into these funding measures? That's what we don't want to miss or lose and leave behind when we talk about innovation and funding appropriately.
Thank you.
Did either of you wish to make a short closing statement, or have we covered that?
I'd like to, if I may, Mr. Bolster. In summary, and we've heard this throughout the course of the Royal Commission, that dementia is a growing problem, that we're living longer and diagnosing it better, and that the numbers continue to swell. And this has created a critical need for appropriate care models for this ballooning cohort of Australians. If we don't address dementia as a specific care need, the cost to our country will become unmanageable as families struggle, care workers and settings are ill-equipped, and the health system gets overburdened. We have a responsibility to fund this care in a way that's flexible and creates choice, and as we've just heard, delivers innovation. And we feel that there are some core principles that we'd love to see applied. Funding needs to match the care needs of the community and be available as and when it's needed. Funding needs to take into account a range of parameters linked to both need and quality. We can't simply have a blunt pricing model, which we've referenced a number of times in this hearing. There needs to be a rigorous system of quality management and assessment, which will effectively link the funding with an outcomes-based approach without creating too bureaucratic or a detailed acquittal system. And those who can afford it need to contribute more than those that cannot. People should be able to seamlessly navigate a single continuum of consumer-directed care, regardless of whether they receive it in a home, a group home, a microtown, or a residential aged care facility. Because in closing, we believe that a flexible system such as this will create choice, strong quality, and underpin a level of trust in the system. And that will lead to better quality care and life for our residents, for families who feel supported, a health system that's not overburdened, and overall, much better value to our wonderful community. Thank you, Mr. Bolton.
Thank you. Ms. Chadwick, was there anything you wish to say very briefly?
Yes, if I may, I agree with much of what Jonathan has said. I do think that in everything that we are developing at the moment through the Commission, we need to think about innovation and how we can support innovating. Not just innovation, but innovators, people like myself and group homes. And to do that, I believe that we need to ensure that there is a level of flexibility that is built into the framework and the systems and processes so that we can ensure not just quality of care, but in equal measures quality of life for the people that we provide care and support to.
Thank you very much. I have no further questions, Commissioners.
Thank you, Mr. Bolt. Thank you to both of you for making the time now on 2 occasions to inform our deliberations. We're grateful to you for that, and I formally excuse you from further attendance. Thank you.
Thank you.
Thank you.
Thank you. Commissioners, we have another panel now with 3 members. I'm ready to proceed with that. While that's happening, could I indicate for the record that there have been further documents added to the general tender bundle at Exhibit 21.1. These documents appear at tabs 124 through to 135 of the general tender bundle. Tab 89 of the general tender bundle has been replaced with a revised version of the document that was tendered at that tab at the start of this hearing.
Yep.
Commissioners, I think we have the witnesses. Mr. Marmarellis, can you hear me?
Yes, Council.
And Mr. Bennett and Ms. Chalmers, can you hear me?
Yes. Yes, we can.
All right. Commissioners, I call Chris Marmarellis, David Bennett and Shane Chalmers.
Mr. Marmarellis, do you swear by Almighty God that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Ms. Chalmers, do you solemnly and sincerely declare and affirm that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. Bennett, do you swear by Almighty God that the evidence you shall give will be the truth, the whole truth, and nothing but the truth? Please say, I do.
I do.
Mr. Marmarellis, we'll start with you. Could you please state your full name for the record?
Chris Marmarellis.
And have you prepared a witness statement, which you should see very shortly, RCD *0335.0001?
I have.
The facts that are stated in that statement are true and correct, are they?
Yes, they are.
And the opinions that you have expressed in that statement, you honestly and genuinely hold them, correct?
Correct.
I tender Mr. Marmarellis' statement, Commissioners.
21-23.
Now, Mr. Bennett, there is a witness statement of Mr. Paul Sutton dated the 10th of July 2020, which you should see in front of you, RCD *990378001. You're familiar with that statement?
Yes, I am.
And who is Mr. Sutton?
Mr. Sutton is the Victorian Operations Manager for Environment Healthcare. So
And are you able to attest to the truth of the facts that are set out in that statement?
Yes, I am.
And to the extent that Mr. Sutton expresses opinions there that are his, are you able to assist us in elucidating those and providing us with your opinions in due course?
Yes, I can do.
Ms. Chalmers, does the same thing apply to you? Have you read that statement? Are you content with the truthfulness of it?
Yes, I am.
All right. Well, on that basis, thank you very much for agreeing to give evidence. Let's start with you, Mr. Marmarellis. Can you give us a summary of the Widden organisation, with an emphasis perhaps on matters that we need to know for funding and financing purposes?
Yes, Councillor. The Widden Group is a not-for-profit organisation. We've been in existence in excess of 70 years. We operate across residential aged care, community care, and in the retirement village space as well. We have a significant regional footprint, so probably over 50% of our homes are in regional Australia, generally New South Wales and southeast Queensland, caring for close to 2,000 residents in our homes, probably another 300 plus in their own homes, and a similar quantity of residents in our villages. Widden is an organisation that is known for our innovation, our model of care, relationship-based care. We were asked to attend the Royal Commission in Perth to talk about that as well. And I think in the context of the funding challenges that we're facing, that we're discussing, I think the regional challenges are pretty evident and obvious, and they're right in front of us. And I think some of the discussion around innovation and being able to fund innovation is particularly relevant as well. So they're two standouts that are core to Widden's philosophy, Widden's views, Widden's approach to care that are certainly impacted by the funding challenges of today.
And Widden's also a home care provider?
Yeah, correct. Around 250 to 300 packages, so providing home care across New South Wales and Queensland as well.
All right. How do you perceive the current financial state of the aged care sector, including the amount of funding available to providers and the way in which it's allocated?
Yeah, I think it's hugely challenging today. As a CEO and an aged care provider, it's quite distressing that so much of our time and our resources are distracted and taken away from care and focusing on the financial challenges that we have today. The system, to me, is broken, and you've heard, no doubt, ample evidence to back that up. And I think we need to reboot. We need to start again. We need to look at what it is we want to provide the care recipients of today. And when I think of our relationship-based model of care, when I think of our My Life model of care, person-centred approach, I think that's a really good starting point. So there's some huge issues in terms of the fragmented levels of funding. I also think that there are other issues that go beyond funding. Those things looking at workforce and that are connected to funding, though, workforce, the innovation stream, and supporting collaboration in those interfaces between other health jurisdictions and health providers. I think that's integrated to the funding challenges that we face today as well.
In your statement, you indicate that the quantum of funding for care and daily living is either totally consumer or insufficient in meeting the expenses associated with operating contemporary aged care. What do you mean by that? And what's the problem with that? How does that impact upon Widden's operations?
So, just for clarity, I believe the statement said, the daily living funding for daily living expenses has been totally consumed. And I guess when you are looking across the 3 or 4 segments of funding that we have there, consumed. If we're looking at the 3 or 4 segments, daily living costs, accommodation, care, etc., the daily living costs, as supported by Stuart Brown as well, the funding we are receiving via the basic daily fee is insufficient to cover those daily living costs. And I believe in my statement as well, in terms of our daily living costs at Widden, we generally have a higher food cost than average, and that's something that's partially a deliberate strategy because of the food provision that we aspire to. It's also compounded by the cost of food in regional, rural and remote locations as well. So there's a bit of a double whammy in that regard. So it's simple that it's just insufficient to cover those costs when you're looking at it through a segmented lens.
All right, we'll come back to the food issue a little bit later. The word cross-subsidisation seems to be a significant one for the way in which you fund your operations. Explain to us the extent to which you need to do it to make ends meet.
Yeah, well, I think that I referred to it in 2 different channels in my statement. One was the cross-subsidising of the different funding categories. So whether care is cross-subsidising daily living or accommodation is cross-subsidising daily living as well. So we're seeing cross-subsidisation through the varying funding categories. However, overall, the business model that Widden functions under is that we have profitable homes that may be, for example, located on the East Coast or in Sydney Metro, and the profits that are generated from those homes are used to subsidise loss-making homes in regional, rural and remote parts of the country. And those homes will typically be in smaller communities where scale isn't an option, although I don't want to understate the importance of those homes. But the model works in that way, that we cross-subsidise with the more profitable homes to keep these homes functioning.
And what about revenue from retirement village income?
Yeah, retirement village income, as does community care income, it goes into a consolidated P&L or in terms of consolidated revenues, and that will also be used to fund some of those activities.
At paragraphs 33 through 35, you talk about how the funding gap and pressure on profitability may ultimately cause elements of the Widden Care model to be progressively withdrawn. Could you please expand on this? Give us an indication of how the current funding arrangements are impacting on care delivery. I mean, you're a large or a medium-sized operator with a significant footprint. How difficult is it?
This is particularly distressing in terms of our values and our goals as an organisation. An example of this is the amount of the funding that we direct to innovation, to enhancing the model of care, which is totally aligned to what the Quality Commission's framework is all about. And we've invested years in this. We've been recognised for the work we've done with awards, with universities, with research. And we have created and developed some amazing programs, our relationship-based model of care. When you look at the funding gap that we see today, and we saw, I believe in my statement, I think I referenced it as probably 2018 or 19, this was a structural tipping point as far as our financial structures are placed. And we started really to see the profitability decline at a more rapid pace. So obviously, you have to put the basics first. You have to put the accommodation, the food, the basic care offering first. And when you're looking at your budgets and you're sitting around with your team, looking at your forecasts, you see this almost, I don't think it's a discretionary spend, because I believe that's what is required to deliver the care that people deserve today. But that is what's under fire. That is what's under threat right now, given the current funding challenges.
All right, thank you very much for that. We might turn now to Mr. Bennett and Ms. Chalmers. Your organisation, Ryman, tell us about the Ryman model of care, at least insofar as it operates in Australia, and then you might tell us how it fits in with your global operations, which take you all the way across the Tasman.
Thank you, Councillor. So I guess a bit of background to Ryman. We have been in Victoria now for just over 5 years, opened our first retirement village 5 years ago, and the model we've taken to Australia is very consistent with what we do in New Zealand, in that we offer a full continuum of care. So for retirees that come into the retirement village through independent and service department or assisted living, and then they can stay with us and we will look after them as their needs change and as they go into residential aged care. So in Victoria now we have 3 villages open. 2 of those currently have aged care, with the third one currently under construction, and another 3 villages also under construction as well. So in the next 12 months, we'll be operating across probably 6 sites in Victoria. If we look at...
How many ACFI beds do you have at the moment?
Currently, we would have just over 200 ACFI beds, and another 40 or 50 of those about to come online in the coming months.
How significant is the link with the retirement village business?
For us, it's very significant. So our offering is the full continuum of care. So we look at a retirement village as a whole. We don't segment into aged care and into a retirement village. And a lot of that goes to Chris's points earlier as well, in that when we're looking at that, we do a lot of cost subsidisation across the different parts of the village. So the retirement village does support our aged care, but our decision to go into a specific area is around a need for both retirement village living and aged care. So we will always take both to the market.
What sort of penetration do home care packages have inside your retirement village, and are you a provider of home care packages?
We are a provider of home-based services, or home care services, but it's a small component at this stage. I think we've only been offering that for about 12 months.
Yeah, just a handful.
So it's only a handful of residents at this stage. But it's a part of the business that we would see grow in the coming years.
And people that receive home care in the retirement village, do they receive it just from Ryman, or do they receive it from other providers as well?
Both, so they can receive it from other providers as well. So.
I'd be interested in your overall impression of the trend downwards in occupancy away, potentially, we've heard evidence of that during the course of this last week, away from residential care and home care towards people receiving care at home. What's your perspective of that in terms of people moving from the retirement village into your residential care offerings?
It's not something we have seen ourselves. So our occupancy of our care centres is very high in Australia. So the two villages we have open would be around 98% occupied the majority of that time. I guess where we are different is the slightly different product we offer with the full continuum of care. So a lot of people come into our residential aged care out of our own retirement village community. So and we are in the metropolitan parts of Melbourne as well at this stage. So I guess we have a stronger demographic underpinning that. All right.
You're a new provider. How have you found the barriers to entry into the Australian marketplace? Is that a difficulty in terms of establishing yourselves as a provider?
Yes, there has been some barriers. The biggest one for us is the bed licensing regime, so the ACAR round. And the barriers that create is the uncertainty of exactly when those rounds will occur and whether you'll be successful in those. And for us, when we want to build a retirement village, we want to be able to build the aged care and give our residents coming into that retirement village certainty over there being aged care services on site. And the bed licensing regime makes that very difficult. And we have had to actually go out and buy bed licenses at up to sort of $90,000 per bed. So last year we spent $30 million as a company on bed licenses. And that's $30 million that we could have invested in new aged care facilities and retirement villages instead. And we find that regime causes a lot of uncertainty for us going into an area in terms of a lot of extra work to find out how we go about getting those license requirements met.
Tell me about the process for buying a bed license. Is that usually from a distressed existing provider?
Yes, sometimes distressed, sometimes people that have been successful in previous ACAR allocation rounds that haven't necessarily operationalised those beds. So they're selling a license that they won for free through the ACAR round, and then on selling that. So they're sort of making profit while actually limiting the ability for new players to come into an area to provide competition. And a lot to Chris's point, when we go to a new community, we want to take the Ryman offering and our level of service so that people can have a choice. And we like to innovate. We like to provide a very high level quality sort of level of care. And we think it's only fair that people get the choice to come into an operator like that.
I take it that you perhaps enter that secondary market for beds in response to expressed demand from retirement village customers or people who come and knock on your door?
Yeah, so we enter that market when we've started building our retirement village because we'll try and get them through the AK round if we can, but if there's no beds made available in that area during that round, or we're unsuccessful because they went to another player, we will at that point start looking to buy them on market so that we can have them available soon after people move into the retirement village. We don't want them to have to wait while we go through multiple AK rounds. So it's pinned to the timing of our development.
If you were not able to offer the combined product, the retirement village and the aged care, in a single location, would you be able, do you think, to establish yourselves just as a residential aged care provider under current arrangements?
Under the current funding model, it wouldn't be part of our growth strategy. We do go with the full continuum of care. The returns on aged care and the uncertainties of the bed licensing regime and around the Rads model as well would just mean that the economics don't stack up, and we would look to other areas.
Well, let's explore that. The Rads would not be sufficient for you to establish the business, the aged care business that you have at the moment?
Typically, the RAD would go close to covering sort of your cost of acquiring the land and building the construction site, but then the remaining ACT fee and basic daily fee struggle to cover, I guess, a lot of the other operating costs of the aged care facility. And because of the resident choice around that funding model as well, you can see your funding lines would have to remain in place to meet future repayment obligations on those refundable accommodation deposits.
Yep.
And yeah, it just causes a lot of uncertainty, and the returns wouldn't be there to have that amount of capital tied up.
All right. Well, let's turn, shall we, to the actual propositions. And I take it that all three of you are familiar with the revised funding propositions. And let's go through them in roughly the order in which they appear. Let's talk about FF1, establishing an aged care pricing authority. Mr. Marmorelis, on page 11 of your statement, you set out the issue of aged care funding not meeting the expenditure growth for providers. And you note that the Commonwealth own purpose expense review indexation has failed to meet wage increases and CPI for several years. That's at paragraph 67. As a solution to aged care funding not meeting expectation growth, you suggested the introduction of an independent authority to review pricing annually to ensure that funding decisions are assessed objectively. I take it then, given that background, you'd be quite content with the way in which proposition FF1 is framed.
Thanks, Councillor. Yes, I was happy to see proposition FF1. I believe we need independent price setting. I think the examples of the past, when we are caring for older Australians, and in women's case, we have thousands of people we care for annually. We can't operate in an environment where the government just decides, for example, to put a funding pause on our revenues. When we are planning around people's lives, we're planning around the people who care for those individuals, and our funding is just withdrawn from us, and literally at a minute's notice. I think the other part of the funding equation as well, in terms of planning and long-term planning, which is essential in the business of providing care, is the notice. You find out literally days before what you're about to receive for the next 12 months. There are a lot of frustrations around funding, and again, I can't stress we're playing with people. We're not playing. We are dealing with people's lives, and this is exactly where that funding is going to. So independent price setting is absolutely crucial. I think it should have a triennial term, so there is some certainty around at least a base rate to see us through for a longer period of time, and a frequent review period that's attached to that. The long-term planning, I can't stress enough how how crucial it is. And of course, I think it'll be covered in other propositions. There are some exceptions that need to be taken for rural and remote locations as well.
All right. Ms. Chalmers, prior to your work with Ryman, you've worked in public health. What's your reaction to an independent pricing authority for aged care? Will what happens in public health in Australia work in the aged care context?
Well, I'm sure there's many more experts than me who can attest to this. However, I have worked in public health in Victoria for the last 10 years prior to this year. And with the independent health pricing authority, I think there has been a certain level of success in terms of driving accountability around public spend. So, I was in Australia during the period where the sort of waste funding that was occurring in Victoria moved across to the states, other states, and was renamed, of course. But ultimately, through that, there has been, I think, greater transparency and standardisation, accountability, but also innovation for public spend. So I think the opportunity to have a pricing authority, I think, is really important and something for the, seriously to be considered. Absolutely.
All right. We might then turn to funding and finance proposition 2, that is funding for indirect costs. And Mr. Barnett, I think Mr. Sutton's statement, paragraphs 55 to 57, notes a number of indirect costs that an aged care provider incurs that are not covered by government funding, and he lists some examples. Do you believe there is a case to be made for indirect costs to have separate funding streams? And give us an example of the sort of coverage that you would need under that sort of model.
Yes, I believe there is a need for that additional funding because that allows you to sort of ring fence, I guess, some additional funding to innovate the offering and the training that you're providing to your staff that we sort of touched on there. So one of the systems we've developed called My Ryman, we've spent a number of years developing an in-house application. That means we have a tablet in every resident's room, and that means the care notes are with the resident when our carer goes in to visit. So they have a lot more certainty around and clarity around what they're providing, and just lifts the standard of care. But that's something that's going to become a bigger focus in the years to come as technology and other sort of aspects play a bigger part in care delivery, and having the, I guess, funds that indirectly allow you to do that would be very important to the continued enhancement of care.
Mr. Marmarellis, what's your perspective? What sort of administrative costs aren't covered that need to be?
Thank you. Look, every business comprises of direct and indirect costs, and if you look at Widden as an organisation, I think you could probably split it into 3 segments. You could look at the standard indirect costs that all organisations face every day: IT, support, finance, costs, administration. There are a host of costs there. Importantly, attached to that is the quality, the clinical governance component as well. There's a huge cost, and with the implementation of the new quality standards over the last couple of years, we've had to invest very heavily in systems, in people, in resources to administer and ensure that there's a certain standard that we are achieving there. I think then you look within your indirect cost structure at things like innovation and how if we want to innovate our care model, if we want to develop the care offering and focus on outcomes for individuals, how are we going to innovate if that's not funded, if that's not built into the funding model? So innovation is also extremely important. And I don't want to understate the importance of education as well. And I think we've really seen the focus on education through COVID, particularly in Victoria. And we speak about face-to-face versus the online training components. there is a huge education component which is built into your indirect costs, and there is a long way to go. We have more to do, and funding truly has to support that if we're going to be asking our workforce to do more.
Just going back to innovation, because it was the principal topic of the last panel, and I don't know whether you were able to observe any of the questioning there. Assuming it costs a little bit more to innovate, but assuming that there's a policy imperative that says, well, that's a good idea and we should always be trying to do it, how should these sorts of funding models not kneecap the very programs that we're trying to develop and trying to encourage?
Thank you. Funding is obviously a core component of the innovation process. Without adequate funding and resources, we can't innovate. And I've seen that firsthand when I look at relationship-based care. We run trials, we partner with universities, we gain insights from other third parties. We have our own team who go through the innovation process to either make or break that outcome. And I've seen the outcomes firsthand. I've seen what the research tells us, and the outcomes are outstanding, and they're benefiting the people we care for. So funding is a core component of that. The way we have done it in the past is using the profits we have generated from our operations. We've been able to allocate funding towards innovation. As a not-for-profit organisation, we also benefit from some bequests and donations we receive. I don't really think that is the core component of it, but we have benefited from bequests and donations. And I struggle to think from a for-profit perspective that would be even more difficult to under the current funding regime to really invest in innovation. So we need greater levels of profitability to achieve that. And I think through federal government grants and being able to explore that a little more, that could be another avenue which would complement being able to fund them out of your operating profits.
Can I stay with you, Mr. Marmarellis, about FF4 and how we deal with thin markets? You seem to operate in a number of thin markets, and it would seem that your facilities in the cities are funding those operations. How should the Commonwealth, let's assume that we don't need cross-subsidisation. What's the approach for the Commonwealth when it comes to thin markets, and have we got it right there?
Yeah, thank you. I think that there's a combination of things in these thin markets. I think that one is funding. The current model, the Triple M model, to me is not satisfactory. It's substandard. There are inconsistencies. I see homes in Moree that should be receiving more funding than a home in Wee Waa, or equivalent funding to a home in Wee Waa or Walgett that doesn't. That doesn't make a lot of sense because we're using geographical boundaries. So funding is certainly an area that needs to be looked at, and there are different models that are proposed that may achieve that. I think
just pausing there. I mean, I take it that one of them is MM7 and the other's MM6, and that means a significant change in funding, even though the actual cost of operating in both locations is probably comparable.
Sorry, the cost of those locations, the cost of those locations is comparable. The operating costs are comparable in those locations, and the other with an independently set price and some sort of an exception added to that for the regional indices that we experience. That I think that could work. I think we could make that work. I just wanted to make the comment regarding collaboration with LHDs, sharing resources. I think the funding is crucial, but my experience in terms of accessing suitably qualified staff, for example, that are sitting in hospitals adjacent to our homes, and I do believe that through proper sharing of agreements with the right intent and motivation and collaboration from New South Wales Health working together with providers, we could access and share some of those resources, and that could work both ways. I also think it's absolutely crazy that in a location, say, such as Burke, we operate a kitchen, and in the MPS next door there's a kitchen, and there's a laundry there, and we have a laundry, and we're both struggling to compete financially in the environment. So, but collaboration with LHDs, with state bodies in particular, is extremely difficult, and there's a lot of red tape, and there's not always the willingness that you need to get the outcomes you're after.
Right. We might turn then to the Ryman perspective. I mean, Ryman operates in regional and, I take it, remote areas of New Zealand. How do you account for the thin markets there in terms of funding?
In New Zealand, the funding is facing the same challenges from the thin markets perspective. If you look at a lot of the new developments, what is occurring in aged care, and it's pretty limited in terms of new developments in aged care in New Zealand, that's all happening in the metropolitan cities in retirement villages. So it's the operators providing a similar sort of level of retirement village living with some aged care associated with that. You're not seeing a lot of new development occurring, if any, in the regional parts of New Zealand, and that's because New Zealand's grappling with the same issue around funding and how you support regional parts of the country. So,
is there a markup? Is there a loading paid to someone in the outskirts of the South Island, for example?
No, there's not, to be honest, and it's probably actually slightly less in some of those more regional parts than Auckland, for example. So there is no markup, and I guess one of the other issues we face is the wage costs, as Crystal touched on, is comparable across both. But the cost of people living in Auckland is significantly higher as well. So there's a disconnect from a cost perspective as well as the funding and how that works.
Have you looked at rural and regional and remote Australia as a possibility for an aged care facility?
Yeah, we're at the moment focusing on Victoria, and we have sort of looked at all of our sites, metropolitan Melbourne or down in sort of Geelong parts, but we have explored other areas and we'll continue to look.
Would a combination of FF2 and FF4, though, make it more attractive for organisations such as yours to develop a presence?
Yes, it would. So at the moment, our model is underpinned by the cost subsidisation, which relies on house price inflation associated with the retirement village units. But if you had additional funding coming through in some of those regional parts, it would make the aged care proposition more compelling as well to support that decision. And look, we do have a number of retirement villages located in regional parts of New Zealand, and they are profitable as a whole, but you wouldn't go in and build standalone aged care in just a regional part of the country.
All right. Well, Mr. Marmarellis, what are the factors that an authority charged with determining the cost of delivering aged care services across the country should look at when it comes to these sorts of thin markets? What's being missed out at the moment?
I think that in terms of the cost structures that you face, as an example, in these locations, there are well-documented locality indices which show you the price premium or the cost premium that you will experience in a location like Bourke, Temora, Wee-Waa, etc. And that extends to construction costs, but it also extends to your operating costs as well. So I think we need to take those into account as a starting point. Labour and skilled labour is extremely challenging, and particularly when you're talking about the provision of care to senior Australians. So we have to look at incentives to get the workforce into these locations, and I think that it's a bigger story, it's a bigger issue than just the funding on its own. But we need to look at what we can do to get the workforce out there. I think I put in my statement something along the lines of I can pay $100 an hour, I can pay double the EA rate to get a registered nurse into a place like Bourke, which we have done because we've had to do it. And it's not sustainable. So attracting adequately skilled people to these locations is crucial. And the other aspect, of course, is if we care about these communities, communities have got 2,000 populations of 2,000, 4,000. They're there. They've been there for a long time. How do we encourage investment in these communities? Because right now, the returns don't warrant investment in these communities. So we have to fund ways, and that will come if we can stimulate profitability, if we can come up with working strategy, workforce strategies there, and potentially look at promoting more grants to support construction in some of these locations as well. The one thing we don't want to do is walk away from these communities, and the way the funding structure is set up right now, it's leaving us very little choice.
Could we turn, please, to funding proposition number 7, that is case mix adjusted activity-based funding. Mr. Marmarellis, why would that be a good idea?
Thank you. So the case mix adjusted funding model is more closely aligned to the system we have now and refers also to the ANAC structure as well. I think that I've looked at it, and my understanding, using the fixed cost component being applicable to the size, the location of your home, I think priced independently could provide you with the level of subsidy required. Again, priced independently and fairly. I think that the case mix approach will also is a little more closely aligned to managing individual care needs. So I think those two go together relatively well. To me, as we started out with this conversation, it relies on independent price setting. And if we can get that base rate, we can get the platform where we commence that price correct, combined with the right factors that are adjusted for regional, remote, and other outliers as well. I think that combination could work. The only caution I have on the case mix approach is I'm not a fan of the ACFI model, like you will probably have heard from other witnesses previously. It promotes security. It promotes people getting sicker, basically, and that's something that goes against everything we do. And I see a little bit of that in the RUX model. So I think that would be my only words of caution around that.
How would you modify the RUX model to get around that problem, as you see it?
Well, I think we need to incentivise providers for good performance. I think we need to incentivise providers for innovation. I think we need to incentivise providers for wellbeing and reablement programs, because all of those things that we do today as an organisation, there is no incentive. We do that because that's what we do, and we go against the grain essentially to achieve that. And that's not really how a contemporary system should function when we have it at the heart of what we're doing in care for older Australians. So I think we need to build in things like that to promote that kind of thinking, to promote that level of innovation within the models of care that we operate under today.
Could we just talk very briefly, Mr. Bennett, about the New Zealand situation? Do you have a case-based model of funding in New Zealand?
Yes, we do. It's, I guess, a lot simpler than the Australian model. We have sort of primarily 4 acuity levels in New Zealand, and everyone fits into each of those 4 categories. That is currently under review as well, and interesting enough, the parties undertaking the review are looking closely at the Australian model.
The existing model? The existing Australian model?
Yes, no, I would hope that we don't go to the sort of 64 levels of funding that you can get through the ACFI model. I agree with Chris that it's overly complicated and rewards the wrong sort of performance. I personally think somewhere sort of 10 to 12 levels of funding and putting people into various case mixes works. I like the Aussie model where you have a basic daily fee, an accommodation component, and then the care-related component. And that care piece is perfectly aligned to the case mix. The rest of it's a bit more user pays driven. And I would like to see a bit of a refinement to that, to take away some of the, I guess, subjectivity in that assessment, and to reward other sort of block funding through innovation and technology and meeting certain care standards.
All right, moving along, can we deal very briefly with FF10, and that is the proposal to introduce immediate funding to match staff to improve quality of residential care. Mr. Marmarellis, what's your view about that proposition?
Thank you. FF10 was focusing on immediate needs, and it was a short-term proposition to sort of see us through until reform could go through the motions. And I think that we obviously need additional funding. It's obvious that we need it, and we need it now more than ever. I do get concerned in the short term, anchoring that to staff ratios. And I say that for two reasons. I say that because of the challenges that I experience every day in managing those ratios in some of the locations. So it needs an objective measure to assist with some of those challenges that we find in locations like Burke and Walgett. And the other thing is, right now, we can't find staff. For the first time that I can remember, we have 2 or 3 facilities or two or three homes that are ramping up and opening after construction or after acquisition. It's speculated that Job Seeker has contributed to that challenge, particularly at the entry-level sort of care role. Going beyond that, we have bolstered our workforce throughout COVID to support all of the initiatives, and we've thankfully been able to keep all of our residents safe with a lot of initiatives. But I don't know where we could find additional staff if those ratios change, because they're not there right now. So we need funding. We're all for having good staffing models that provide care, the care models that we need today. I think some of that could be unrealistic and put providers under a lot of duress at the same time. So I don't know where those staff are going to come from.
All right. Mr. Marmarellis, could we turn to the question of RADs? How significant are they for the operations of the Whitten Group across metropolitan, rural, regional and remote? How significant are they in each of those locations?
Significant in the context of ongoing operations? Is that the question?
Yeah, yes.
They're extremely important. They're important in the context of a construction project which we have undertaken numerous of, in terms of raising capital to fund those projects and raising capital for future projects as well. So they play a significant role in the aged care space and in the profile of the aged care business.
That leads me to the question of prudential regulation, and I take it, given the number of facilities and the number of RADs that you hold, what's the way in which the Commission can make sure that when there is a risk of a liquidity issue arising in a provider, that there's some notice of it before it's too late?
Yeah, this is a really interesting question, and we are governed under the Act with the prudential reporting regime that's currently in place. So what that means is we will put in a return that is completed as at 30th of June. It's submitted at the end of October, and all that data is then processed by Department of Health personnel. And my understanding is if there's a red alert of some description or some sort of anomaly, it will be flagged at that point and someone will come to us. The question you raise, and if you look at the environment we are in right now, there is a lot of risk right now. We have made structural changes to our balance sheet, and we hold good levels of liquidity, probably more than others, to support our RADs, and that's a typical profile of a not-for-profit organisation. So we've made changes as a board and an organisation to support that. However, there is a great deal of risk. I think we've heard in previous hearings that occupancy is dropping, and Whitten has certainly seen that, and it's understandable given the perceptions out there in the community right now. And with that, the ability to replenish your RADs is diminished, and so that risk is becoming more and more real. And it's compounded by the other factors with the shift from RADs to the combination payments and so on. So I'm really surprised that the Commission is not knocking on providers' doors right now saying we want to see some KPIs that give us a good indicator of how your liquidity is. And we've also acquired a number of homes over the last couple of years who have had great challenges, and it's not a proactive process of managing liquidity, it's a reactive. And right now, there is with the right conditions, the right economic conditions, the right changes socially, the right changes to perception, there is a house of cards, a $30 billion house of cards that we are sitting on.
What is the red light indicator that could be a marker for reporting or a form of compulsory disclosure? We discussed this on Friday, and there was some discussion about this this morning. What would set your alarm bells ringing if you were in the position of the prudential regulator?
Well, as an operator, we're performing regular cash flow forecasting and reforecasting. And when you start to see your net inflow of RADs start to decline and you start to see your occupancy start to decline, that's your first trigger. And if you start to project that your replenishment of RADs is going to be negatively adverse, then you want to tie that back to your overall cash flow. So I think regular cash flow monitoring of some description is really important. I think being connected in some way to the cash flows of each organisation, understanding their liquidity ratios now and in the future, what are their liquidity strategies and their financial commitments into the future. I think gathering that information and processing it regularly and frequently and not 6, 12 months down the track, that's a huge issue right now in this environment.
Do you provide liquidity updates to your bankers on a quarterly or monthly or yearly basis?
We're fortunate in that we do not have any debt with the banks at this point in time, but having been involved with organisations that did, it's quite a common practice to provide quarterly, monthly updates to the bank regarding liquidity, RAD intake, and operating cash flows and profitability.
There seem to be two options on this continuous disclosure. One is to make providers report on a quarterly basis. The other is to draw a line in the sand on cash flow and occupancy. Can I pin you down on the sort of change in cash flow that would worry you, that should be a marker, that you should report?
Well,
and the same thing about occupancy.
Well, I think that if a decrease in occupancy combined with the impact that has on your resident intake is resulting in a deficient cash outflow, that can be measured and quantified quite easily. What does need to be taken into account is the cash reserves of that organisation, because that may be sustainable for a period of time, 3, 6 months. And, you know, we are all of the belief that we're going to see the occupancy bounce back as COVID comes to some sort of conclusion and confidence is gained in the community. So you can measure that quite easily. But I think that decrease in occupancy and the net receipts, if those net receipts start to, you start to see a negative trend, you start to map that out and project that going forward, and you can quite easily see what sort of impact that's going to have on your liquidity and your cash flow.
Your management accounts would pick that up on a monthly basis, would they?
Yeah, and our management accounts through the cash flow and the other reporting we do, they're exactly right.
Very briefly, Mr. Bennett, do you cavil with any of that, or can you suggest a bright line marker for us?
And I think, as Chris touched on, a bright line marker around occupancy or cash outflows is very hard because every organisation is different. I think it's around, if you're going to have a bright line test, it's your liquidity sort of requirements under the prudential reporting, and a trigger that if you breach any of those, then you are required to report that immediately, would be my view on that.
Thank you. Let's turn to a different topic, and that's co-contributions and means testing. Perhaps if we could bring up funding FF 17 and 18. Mr. Bennett, in Mr. Sutton's statement, he states that annual and lifetime caps on consumer contributions are quite low compared to the cost of care. What's the Ryman view about what should happen to these caps?
Yes, I guess if we look at it from a New Zealand context, and what we're used to is in New Zealand we have an asset test on an individual, and you are required to contribute to your cost of care up until you get below that asset threshold, which is currently around $230,000. So there is no lifetime cap, and so that for us looking in is a cost on the Commonwealth.
What if Mr. New Zealand is earning $1 million a year? Does that affect this means testing arrangement?
I would assume then he has got assets significantly above the 230, so he would be paying all of his cost of care. So the government pays above a prescribed maximum contribution, so they will top up for someone that requires a higher acuity of care and or dementia care. But otherwise, people are required to pay for their aged care until they get below that asset test.
What if the assets are held in a series of trusts away? The income is the income at all relevant?
No, there is an asset test, but they are looking at the whole trust regime and the look through on those so that people can't hide their assets as strongly in the.
But my point is that it's the income of is completely irrelevant, isn't it, to the funding of care?
It is, but I think Australia's two-pronged test works as well, having an income test and an asset test. There's no reason why you couldn't apply both.
Do you find the two-pronged test easy to administer and to give potential residents advice about when they come and see you?
It's not the easiest to give advice about, but I guess it's in New Zealand in particular, it's been sort of in place for a number of years, and Work and Income here do that assessment. So it's an independent body that do that calculation and tell people whether they are subsidised or not. Obviously, that requires a bit of an investment in systems and processes to make that as user-friendly as possible. But it's a test that should be able to be completed because I guess people are aware of the assets they own, whether that's in their personal name or trusts, and where the income is being generated from, or would be able to find out that information.
Well, Mr. Marmarillis, there's a couple of issues in those last few questions. Let's start off with the income and assets test and how easy it is for you to administer that when you have to deal with people who are fairly vulnerable, elderly, and may have difficulty understanding it. What's your view on it? What's your change about it?
I think aged care providers, there is a limitation on the amount of financial advice we can provide, and I'm pretty sure that's contained within the Act as well. So our role is to support residents, families coming into aged care, get them the right resources and give them the right assistance within our realm to navigate their way through that. It is confusing, and there is a process of the initial assessment or the initial means tested charges that go through, then they're reassessed and you have to make adjustments for those. So it's quite a convoluted process. In terms of the fairness around that, particularly around the caps, I think that in an environment where we are struggling for viability, I don't think it makes sense to cap contributions on those who can afford to pay it at $67,000 or $69,000 over that period. I think that if someone is sufficiently resourced, they should be paying for it. And that also gives us the ability as a nation to provide care for pensioners using their pension, 85% of their pension. I think that's something we should be very proud of. But those who have the means and assets to pay shouldn't be capped over 2 years, given what we're seeing now. So generally, there are two things that really stand out to me about the current setup.
All right. Proposition FF 1718, let's turn to that directly. Is there anything about it that concerns you, Mr. Marmarillis?
So 17 and 18 are focusing on daily living and the daily living fee, and I think that I'm generally comfortable with that. I tie that back to the fact that non-means residents, residents who have the means and the capacity to pay, I think we need to review that. I think there were recommendations in David Churn's report about what that could look like. And I think that I don't have a problem with them being regulated above the basic level, as long as that's done objectively and independently.
All right. Mr. Bennett, is there a view that you have about Proposition FF17 and you too?
No, I would agree with Chris's comments very much that if people are able to meet will have the means to pay for their care, then they should. And yeah, that pricing should be set independently around the amount of aged care funding we receive.
All right. Will you just bear with me for a moment? If we could perhaps please go to Proposition 11.3. Withdraw that.
Thank you.
Do you have that transcript? If we could bring up the transcript from Friday afternoon at 9478.39. Mr. Campbell Ansell gave evidence on Friday. I don't know whether any of you had the benefit of that. He proposed that if Daps were to be based on a WACC model, that's a weighted average cost of capital model, with the cost of care inadequately funded, rather than the Daps being based on the MPIR model, would that be an alternative capital financing model that could work for Widden in metropolitan and regional and rural and remote, Mr. Marmarellis?
I think that a base level WACC could work in those more generally across locations. I still think that what concerns me about coming up with an average or a standardised WACC is just that there are so many varying profiles of organisations out there, from not-for-profits with large cash reserves, for-profits that are heavily leveraged, a lot of debt finance involved. So I think there's possibly some sort of a base level there. The MPIR is a broken model. It's regressing at a time where prices are rising, and it's going totally against the grain right now, and it's also incentivising a shift away from RADs. So I agree that from an MPIR perspective, we need to find another mechanism, and I think I put something in there about another form of indexation in my statement. So in principle, I agree with some of those concepts. In application, I just see some challenges in the application of it.
Right. Do you have a differential cost of capital that you record across your organisation, which really does cover a lot of different industry segments?
I think our cost of capital, I think there's some tolerance to it as a not-for-profit organisation that we may not have seen, I might not have seen as a for-profit organisation. It's still a level of viability needs to be factored into that. So I think that we have generally a consistent approach, but I just think that there can be a level of tolerance because you factor in a benevolent or a social dividend into, say, a building project in a regional location, and you might compromise that to some extent based on what your commitment is as a not-for-profit organisation.
Mr. Bennett, Mr. Sutton indicates at paragraph 164 support for calculating a cost of capital on a WACC model. Could you perhaps tell us what you think are the most significant advantages of that from your perspective?
Yeah, I guess the reason or the rationale for that for us was, as Chris touched on, the MPIR just is a broken model, and certainty around that level of funding you're going to get via either DAP or RAD in the applied rate. Using a WACC gives a bit more of a linkage to you directly rather than the MPIR that, as Chris touched on, is going down at the moment at a time when cost pressure is going up. And so that's why we saw that as a more preferred model.
Thank you very much, Commissioners. I have no further questions.
Thank you, Mr. Morse.
Yeah, I've got two kind of curious questions, but I've been thinking about this for the course of the last 6 days. The first is, why do city homes, or why are city homes able to make a profit, basically, that you're then able to distribute? Is it because they've got higher income people who are using the services? Is it because you're able to charge quite a lot for the RADs, or what is it that makes this difference, apart from the cost structures being higher in the country?
Thanks, Commissioner. I think that there are probably a few parts to that. I think typically you'll have scale in your metro homes, and scale will, to a certain extent, generate greater commercial outcomes. I think you will also attract greater RADs, and those RADs convert into Daps, and so that will also improve profitability by virtue of the higher daily fee you're getting. And of course, the higher costs can't be underestimated in those regional, rural and remote locations. And there are a lot of examples of those costs, from labour to food costs, accessing allied health, et cetera, So there's a few different factors there that just come straight to mind, and it is certainly a challenge.
Okay, the second question is, when you have a RAD or a system of RADs and you go to the bank to get a loan based on that, it just seems to me from the answers people have given that the typical loan period is quite short, namely about 5 years, compared with normal commercial lending periods, which are much longer. Is that right?
Well, my experience with this in the past is, yes, it's sort of a 3 to 5 year window. Typically, the bank understand the activities of your organisation and your business, so they'll know that over a sort of an 18 to 24 month period you'll be ramping up. They'll understand what your RAD intake is going to be, and even if you're looking at 100, 120 bed facility, 50% are paying RADs in Sydney Metro. There's a large cash inflow coming into that, and the bank will want to see their debt extinguished. So I think the profile within aged care, the profile of what we do in the RADs itself, the RAD intake process, lends itself to a much quicker repay period, and that's what the banks want to see. And in all honesty, it's in your interest to reduce that debt and your interest exposure as well.
So what follows from that is we've seen a significant enhancement in the availability of residential aged care to a level where there are now vacancies, but also an improvement in the quality of the capital stock. And the obvious question is, should this continue, or should there be some other more targeted capital financing arrangement?
So, Commissioner, you're referring to the arrangement of RADs as a source of capital.
I am, yeah.
I think one problem is that it's extremely difficult to undo where we're at the moment. So rather than try to undo it, we need mechanisms to reinforce it and support it and build more confidence into it, particularly when we're facing economic shock and things like we're facing today. I think the system has served us quite well for many, many years in terms of the capital generation that it brings in. I think we're now shifting to this question of protecting residents' RADs in these times of uncertainty. I think that's really the big issue right now.
Thank you.
I assume, Mr. Mammarellis, in responding to those questions, that the function of the RADs is essentially the capital, to use it for the acquisition of the capital structure of the facilities, so that if you had it for a long term, you would end up with double your loans rather than only one single loan. Does that make sense?
So I think you're saying that the Commissioner, that the use or the value in those RADs is to continually extinguish that loan rather than to compound it?
Yes.
Yeah, so in other words, the reason you go to the bank to get the money is on the basis that you're going to use the money to invest in the capital structure, and what the RADs then does is substitute the capital that the bank gave you for the capital that you get, in effect, from the residents. And if you didn't do that, you would end up with double the debt rather than one debt in the form of the RADs substituting for the debt for the banks.
Yes, I agree with that, and in some cases that RAD component just assists you to get the viability level you need on that project. By substituting that capital, it'll help you get that project over the line. Although obviously that's becoming more challenged now as profitability declines, because that's a component in that equation as well. But yes, so I agree with that comment, Commissioner.
So looking at it the other way, if you had the RADs, you wouldn't need to go to the bank.
Correct. But it's chicken and egg type scenario, though. That's the thing to consider.
So in effect, what the bank is doing is giving you advance funding until you can get the structure up and running, and then substitute that funding for the RADs.
That's correct, and the bank know that money's going to come in pretty quickly. They know it's very unique, and they know they're going to bring that cash back in within that sort of 18 to 24 month period, and that's a pretty rapid intake to extinguish debt.
Yeah. But it may not be all that rapid when you compare it, for example, to construction cost of apartments and properties where the intention is to sell them.
It's a different profile in that environment, and it's a lot more complicated in rural and remote because of those low house prices in those areas. So the cost of construction is going up in regional and rural and remote to what we would build in Sydney Metro. Yet house prices are, 300,000-400,000. So we can't make that equation work in those locations.
Yeah, I understand. Anything else? Thank you both very much for, was that both, or in fact three of you? Thank you all three of you very much for the amount of work that you've put into this. We do appreciate it a great deal, and we're conscious that every line that you put and every answer that you give has behind it a great wealth of experience, knowledge and work, and we are indeed very grateful for you sharing that with us. So I'm delighted now formally to excuse you from further attendance, and thank you finally. Thank you.
9:30. Commissioner.
Thank you.
Thank you.
We'll adjourn to 9:30 tomorrow morning.
The Royal Commission is now adjourned until 9:30 a.m. on Tuesday, the 22nd of September.